Inflation. I think it's been clear by the Fed that that is their target.
I think they've already likely gone too far.
If the Fed feels they can't slow down from that 75 per meeting pace, that's really going to clobber the economy.
My view is that the Fed blinks. The U.S. might not be in a recession and maybe on the cusp of a recession.
We're not looking at, the Volcker recession of the early 1980s.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together this morning with Katie Lyons. Bramo back in the seat next week. Futures down by about 1/3% on the S&P. TK, we have to begin with heartbreaking news out of Japan.
Crushing. I can see the Prime Minister, as we speak, absolutely shattered off on one of my feeds here. John, will go to end current here in a moment. I'm hoping to speak with Robert Feldman of Morgan Stanley. We'll see on that. John, this is a tragic loss for the domestic people of Japan. My first message this morning, John, is this is not about that acclaimed phrase, Abenomics. This is about a family that spans Japan from the recovery out of World War II.
Tom, getting reaction from around the world. Japan's Prime Minister saying this a little bit earlier. It is a barbaric act that took place during the election, which is the base of democracy. It is absolutely unforgivable.
When you look at what he accomplished, it goes very much, John, to domestic politics. His grandfather was a Class A war criminal of the United States of America, became Prime Minister of Japan in the 50s, and the grandson followed on to amend and soften the harsh militaristic rhetoric of the ultra-right of Japan. He paid that price this morning.
Kelly, you caught up with Joachim Fowles of PIMCO a little bit earlier this morning. And in his words, and I wrote them down, his legacy is very much alive.
Yeah, the idea that Abenomics is going to live on, that you are still seeing a continuation of these economic policies in Japan as we speak. For all of the tightening we talk about elsewhere in the world, policy in Japan still easy. They are still trying to stimulate an economy that for so long has struggled with the idea of deflation and stagnation. And of course, Abe, during his time at Prime Minister from 2012 to just about 2 years ago, John, that was one of his primary goals.
We will, of course, stay on top of the latest news out of Tokyo, Japan, throughout this morning on Bloomberg TV and on Bloomberg Radio. If you're just waking up this morning and looking for some price action, I'll whip through that for you as well. Just briefly, futures are negative 1/3% on the S&P 500. On the NASDAQ 100, we're down about 0.4%. That's not the story of the week. The story of the week so far is 4 days of gains. On the S&P 500, we had a fourth yesterday, the longest winning streak going back to March. Yields in by a couple of basis points to 297.24, call it 297.50. Katie, all of that going into payrolls a few hours away.
A few hours away, but before we can even get there, John, we also are going to hear from another central banker in Europe. Christine Lagarde will be speaking at the Aix-en-Provence conference, the French Davos, later on at 7:55 a.m. Eastern time. Yes, I'm interested in what she has to say about the July meeting. Is 25 basis points still the case she wants to make? What about that anti-fragmentation tool? But maybe more interestingly today, what does she have to say about a euro at its weakest level since 2002? Once again, we find ourselves on parity watch with euro dollar trading at 101.24 this morning. As for that payrolls report you mentioned, John, 268,000 non-farm payrolls added in the month of June is what we're expecting to see, along with an unemployment rate of 3.6% and wage growth of about 5% year on year. But, John, the question really is going to be, is there anything in these numbers that alters the case for the Fed? Because we continually hear the focus is on inflation, less so on this labor market. Is that the message we will hear post-jobs at 11 a.m. Eastern time from New York Fed President John Williams, who, of course, will be speaking after we heard from Waller and Bullard yesterday, both making the case for another 75 basis point move, playing down the risk of recession. Is that a similar message that we'll get later this morning,
And
John?
Bullard talking up the potential for a soft landing as well. Kelly, thank you. Great to have you with us through this morning. Tom, just looking ahead to this payrolls print, Citi and Andrew Hollenhorst have really led the way when it comes to expecting a hawkish Fed. This is what they have to say going into the payrolls print. A solid 290K jobs number with upside risk to wage growth could be the next catalyst to price out the near-term recession narrative and price back in a confident pace of Fed hikes into 2023.
This is the heart of the matter. It's been voiced, say, by Jan Hatzius, I think, very cogently at Goldman Sachs as well, but many, many others, John. Do we have a strong economy, as Chairman Powell talks about? And at 8:30, you know, my phrase is you go beneath the headline data. Well, okay, maybe so, but maybe this is the jobs report where the headline data really matters.
Tom, starting to see some pockets of weakness, not in the headline data in the labour market, But elsewhere, perhaps, we had that weak ISM last week, just looking at the orders component of it. Looking at the employment component of this week's ISM, Mike McKee very keen to point out that within that data point, they talked about the supply side story, not so much about the demand, Tom. Are we still in a supply-constrained economy? And most economists, Tom, would tell you we are.
Well, that's going to be the debate. I think there's going to be a lot of activity over the weekend, John. I know you're already sliding into the weekend already after returning from Washington, but many others aren't. They're going to work through the weekend to recalibrate off of this jobs report, and it is a recalibration off the supply shock guess and, frankly, the demand mystery that's out there.
TK, what do you make of the bond market move, just briefly? We've creeped higher this week by 9 basis points, 297, just south of 3% again. Bit of curve inversion still out there.
I'm going to steal a phrase from Peter Bernstein and maybe Douglas North at Washington University, St. Louis. The ambiguity is knee-deep, John. I mean, the ambiguity right now on the Bloomberg screen is extraordinary. I would point out dollar strength as being a resilient feature this week.
That's the main event for the market that will take place at 8:30 Eastern Time. Looking forward to that jobs print. We begin, of course, this morning with a top story out of Tokyo, Japan, and we can catch up with someone very special to us. It's Enda Curran, our Chief Asia Economics Correspondent. Enda, let's just begin with the sad news out of Japan, the death of the former Japanese Prime Minister Shinzo Abe. Can you help all of us understand just what we've woken up to? What happened?
Well, it's obviously completely shocking news, Jonathan, and, it's been described as one of those days that will leave deep scars on the Japanese community for a long time. As you know, the details are scant somewhat, but he was canvassing for the upper house elections. He seemed to have been attacked by somebody and died from the gunshot wounds that he received. Now, that's going to reverberate both through Japan's economy, because obviously he pioneered the extraordinary policy of Abenomics, huge government spending, huge central bank support that, while it had mixed success, some credited for at least reviving the Japanese stock market and at least boosting growth to some extent before the pandemic came along. And then, of course, to the global stage. Abe really put Japan back on the global stage. He was seen as a foreign policy hawk. He tried to mend ties with China, while also, of course, boosting spending on Japan's own military, or easing restrictions on Japan's military, and trying to boost ties with key powers right around the world. So it's hard to understate the shock this will have, both for Japan's domestic politics and for Japan's people, and Japan's standing on the global stage.
And I'm seeing here on my feed into the Bloomberg headquarters here in New York, Mr. Kishida finishing his remarks in the dark of night in Tokyo. Enda Curran, all of the arc of the political dynasty of the Abe family goes back to September 2nd of 1945 in an arch debate in Japan of how to reassert any form of military presence. Abe had the courage to hold off the ultra-nationalists. Did he pay for it this morning?
Well, he certainly he tried to strike a balance in his policy, both his defence and foreign policy with Japan, Tom, because like you mentioned, on the one hand, he had to deal with calls at home to bolster Japan's hawkish foreign policy, to give the military a bigger role, and to some extent he did that. But he was also credited, of course, with mending relations with China, and those relations with China had come a long way until, of course, the Hong Kong issue more or less skewered that progress. And then, of course, the pandemic also upended a lot of what Abe was trying to do, both on the global stage and back at home, in terms of what he was trying to do with the economy, leaving him with something of a mixed legacy on both counts. But I think the big takeaway for Abe will be his hawkish foreign policy on the global stage. And especially, by the way, after office, he was especially vocal in recent months in terms of China's role in the Pacific and what Japan's role should be in that as well. So he did strike a balancing act, obviously. There are very different factions in Japan. He led a very conservative faction, but I think his legacy will be one that he certainly managed to balance it better than others did.
Well, and Enda, of course, his assassination today comes just days before the elections take place on Sunday, and Prime Minister Kishida speaking in Tokyo, as Tom mentioned, saying that he has instructed the cabinet to ensure free and fair elections, that they will take utmost security precautions for the election, that campaigning will continue tomorrow as planned. How could his death today influence the results of those votes on Sunday?
Well, the first point is that the government is going to go ahead with the upper house elections. That's obviously an important signal because this obviously has been an attack on democracy for Japan and, of course, an especially shocking attack given the low level of gun violence in that country. So that's the number one. It's a very powerful signal the government is sending that they will go ahead with the results. It's difficult to know how, of course, it will permeate in terms of ultimately how people vote, but clearly there's a groundswell of sympathy for Abe. For this disaster. And I think looking at some of the initial takeaways on his legacy today, a lot of people seem to be focusing on more of the positives. The positives in terms of what he tried to achieve for the economy. He tried to get women back into the workforce. He tried to push through corporate governance reforms with mixed success, but he tried to. And of course, and as I was trying to explain earlier, on the global stage, he bolstered Japan's status. He tried to cut big trade deals, mend relations with China to some extent, and of course try and bolster its military standing on the global stage too. So I think at this stage, by all accounts, Japan is relisting the loss of what is clearly a political giant for the country.
The word I've heard several times this morning, Tom, was hope. And you remember when he came in for that second try as Prime Minister in Japan back in 2012. Tom, it was hope that this time around they could break out of several decades of stagnation.
The polarity here, John, and it's fascinating, is he was very clear that he was scarred forever by the imprisonment of his grandfather. And this is a guy that was strident that Japan had to re-engage militarily. But at the same time, as Mr. Curran just mentioned, this is a guy who had the courage to address liberality in Japanese society in a party that was hugely conservative.
A special thanks to Enda Curran
yes.
on the latest. And Tom, the team in Asia doing a fantastic job also of just letting us all realize how rare this actually is in all of Japan in 2021. 10 gun-related incidents.
Over the years, 6 Japanese prime ministers, former prime ministers assassinated. There is a trend, John, back centuries.
Waking up to the sad news out of Tokyo, Japan, that the former Japanese Prime Minister Shinzo Abe has died.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former Japanese Prime Minister Shinzo Abe has died after being shot at a campaign event. It's stunning news in a country where political violence and guns are rare. A suspect has been arrested. Abe was 67. He was Japan's longest-serving Prime Minister and was best known for his shock therapy called Abenomics to revive the economy. Boris Johnson is still in number 10 Downing Street after announcing he plans to resign, but his plans for an orderly retreat are being threatened. The ruling Conservative Party wants to speed up the contest to choose Johnson's successor by the end of summer. The Prime Minister's office had floated a 3-month timetable yesterday. And the European Central Bank's first major climate stress test shows banks facing a hit of $71 billion. That adds up credit and market losses from increasing natural disasters and sweeping changes across industries. We spoke with ECB Vice Chair Frank Helderson.
What we have seen is that a disorderly scenario is clearly more risky for banks than if there were to be an orderly scenario. This comes out of this bottom-up stress test that we are presenting today, which is a learning exercise, which is a pioneering exercise. It actually also came out of the broader financial sector macro stress test that the ECB did last year.
The ECB also found that 60% of banks don't have a climate risk stress testing framework. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Got a good chance at a soft landing here going forward. There are always risks, and if there's or a shock that we can't even think about today, that will hit us, and that could happen, and we're always cognizant of risk. But I think the base case is for soft landing at this point.
That was Jim Bullard of the St. Louis Fed going into potentially another Fed meeting at the end of this month with a 75 basis point rate hike. Live from New York City this morning, good morning. Together with Tom Keene, I'm Jonathan Ferro, alongside Kelly Lyons, counting you down to payrolls Friday, 2 hours away. Futures, negative 0.1% on the S&P, yields in a couple of basis points, 297.98, and we are on parity watch on euro dollar, a break of 101 earlier in the session, Tom, 101.32, and I was just looking at the chart on the dollar index, of course, a heavy weighting the euro has in that particular index, and Tom, it's up almost 10% since the end of Q1.
57% of the core DXY index. And John, what's important here is how lonely the euro is this morning. I look at other currency pairs and their triangulations, and this is distinctly a euro story.
Two problems there, hey, Tom. The weakness in growth, an ECB that's going to hike into it. And if you ask anyone this morning what's going to happen to the Eurozone economy, it's hard to find anyone constructive about the path ahead.
Yeah, I had fragmentation yesterday sitting on the runway at National Airport in Washington. It was fragmentation.
Is that what you're calling it?
So is Madame Lagarde calling it.
I hear that the ECB has a name for their anti-fragmentation.
Do they have a policy yet?
I'm not sure they have a policy, and that's the problem, Tom, not just the question.
Well, we're going to have to see. We are continuing to follow events in Japan, and we'll bring them to you as we can. Right now, on this moment of an American job economy, Stephen Whiting joins us, Chief Investment Strategist and Chief Economist, Citi Global Wealth. What do your troops think, Steve Whiting, of this jobs report? I can't frame it. To me, it's massively ambiguous. Am I right?
It's a transition period. You know, you hear people talk about, well, how could the economy weaken when employment is strong? And if you look at non-farm payrolls, the lead time it's given us before recessions, on average since World War II, is 0 months. Literally, again, it's a coincident indicator. If you don't believe me, take a look at the components of the index of leading economic indicators. You won't find it in there.
Steve, you are acclaimed at synthesizing the markets into equities. Help our market viewers today. On non-farm payrolls adjusted for pandemic gyrations, what is a soft non-farm payrolls number? Is it sub 200,000? Is it sub 300,000?
Yeah, if we were below 200,000 already, I would consider that soft. I would consider that on the way to a convincing slowdown. Now, again, where we are, where there's still a lot of production need, catch up in the economy, regardless of what happened to first half GDP gains, we've had consumer spending in the first half of the year after some downward revisions looks to be about a 1.5% pace. Do you need 300,000 to 400,000 jobs per month when core demand in the economy is decelerating? And this is before the effects of, let's call it 300 basis point rise in mortgage rates over 12 months, before the forthcoming tightening of monetary policy by the Fed. So if we look into 2023, financial markets are supposed to be telling us where the economy is going, not where they are right now. It looks like it's going to be a weaker period for employment and could be considerably weaker in 2023.
So, Steve, what do you make of this rally, and what do you make of the churn beneath the index? The rally we've seen in tech, the sell-off we've seen in energy over the last month or so. How do you know whether something is the real deal or not?
Yeah, I think, again, we've been in a period where we've been so focused on interest rate risk along the booming cyclical conditions, higher inflation, so rate risk has been driving markets. I think we have to transition and say that, look, we've got rate risk more than priced, and now we have to take a look at a transition to credit risk. So if you think about the equity market, some of the underperformance of cyclicals, perhaps commodities, more subject to international events, but industrial cyclicals, companies that take a lot of credit risk and the consumer might not be there for them, they're starting to underperform some. And maybe some of the tech companies that have bond-like balance sheets and probably can weather any kind of bump in the economy over a year or two, they're starting to look like they're transitioning to a period where they could have a little more stability. It's a little early for that, but it's definitely the path I think we're on, transitioning from rate risk to credit risk.
What about earnings risk?
Well, again, it won't be necessarily the quarter we just finished, but where we are going ahead. If we can avoid a self-reinforcing downturn, we have to remember that we had 47% earnings growth last year. Profits are really high in the U.S. market. And so if you have a slowdown, it's going to take something out, even if the economy isn't in recession. So again, if you think about all the probability-weighted scenarios, it looks like we're going to have an earnings drop next year. And I don't think that that's going to be reflected so much in second quarter EPS. It won't be a quarter of big upward surprises. But the look backwards is not really that relevant. The one thing I won't worry about quite as much as others is downward earnings estimate revisions. The numbers are not plausible, and we know that stock prices predict analyst earnings estimates.
Steve, awesome to catch up, as always. Thanks for your patience this morning. Steve Whiting there of Citi Global Wealth Management. Into earnings next week. CPI next week on the 13th. And then on the 14th, you'll hear from JP Morgan. On the earnings front, Tom, we're looking for the guide forward. Does anyone have visibility about what this year might bring?
No, guidance is everything there, John. But I would link these together. And I'm going to be honest, John. I know we're supposed to hype the jobs report, so 12 people will stay with us to 8:30. But the inflation report next week is arguably more important. In the inflation report, John, folds into the earnings reality. And again, that guidance about what do they do with the revenue line.
The survey of Bloomberg, Tom, we gave you a sneak peek yesterday. 8.8% on headline year over year is the current median estimate. Getting a drip feed of estimates coming through. When we get more, we'll give you a better picture. But that's where things stand at the moment.
This is so important, John. You know, you go double digits, Spain and all that.
Sure.
We are, we're doing this every day, and we are benumbed by it as a statistical exercise. Our people listening and watching are living 4% inflation or 12% inflation, whatever it may be.
Let me give you a number, Tom. This came from Bank of America. They sent this over to me yesterday. For the lower income cohort who earn lower than 50K a year, gas prices rose to almost 10% of total monthly spend. Almost 10%. And for some other people, Tom, that number's going to be higher.
This is really important. United Nations is doing great work on this, and it folds right over, John, from hydrocarbons over to food. For example, in Southeast Asia, the percent of income on rice.
Futures right now unchanged on the S&P 500. On the NASDAQ, down about 0.2%. Big run in the NASDAQ so far this week. And we are on parity watch on euro-dollar. Euro-dollar a break of 101 briefly. 101.37 right now. From New York on this Payrolls Friday, this is Bloomberg. Live from New York City this morning. Good morning. It is Payrolls Friday, and going into that, we're on quite a rally on the S&P 500. We've had 4 straight days of gains. Might not sound like much, but that equals the longest winning streak of the year so far. Last time we did that was back in March. The S&P right now up by just 0.05%. Incremental, mild gains going into a jobs print a little bit later on the NASDAQ. Bear in mind, we're up almost 5% on the week so far. Tom, that shift into tech, away from energy just over the last month, is something that Mr. Hartnett over at Bank of America has picked up on. Story's slowly changing. How much you want to get behind that move? I guess that's a question we've got to ask through this morning.
Big debate. And the partition here, John, is there a real bid to the market, or is it the classic short covering? To explain that quickly, if you're short, when you get out of your short, you've got to go buy shares, up you go. Which is it?
Is it that bear market rally that many people think it is? In the bond market, 2s, 10s and 30s, yields at the front end just creeping higher through the week. We've gone from 283 back through 3, north of 3% right now. Coming in just a little bit, down a basis point. Citi looking for a decent enough number at 8:30 Eastern. Decent enough being something in and around 290 for them to tee up the Fed on July 27th to go another 75 basis points. This conversation still going on, even with an ECB who hasn't made a move yet. We're still at negative 50 on the depot rate of the ECB, and this is what euro-dollar looks like. Euro-dollar broke 101 this morning. Right now, 101.39. Tom, we are on parity watch, and this currency pair has had more than a 10% move so far this year.
And very lonely, and it's the way it broke a 101, a weaker euro down near 1.00. So we're watching that carefully. Also on radio and television, we welcome you this morning, the assassination of the former Prime Minister of Japan. We continue to monitor that story of a shocked Japan. Joining us now on this jobs report with some great acuity is Yelena Shulateva of Bloomberg Economics, who has the courage to go below non-farm payrolls, 268,000 off of a prior 390,000. We go deeper right now with Bloomberg Economics. I want to talk about, in the pandemic, we were all focused on bars and Yelena, at least I was focused on bars and restaurants. Help us here with the mix now, the industrial mix, the movements within our American economy.
Absolutely. I think that's going to be also important to watch, apart from the overall headline number, what is happening beneath. So we will be watching the Diffusion Index, which actually shows how broad-based gains are. So that is important because people can still find jobs even if they get laid off from the industries that are experiencing some, some effects from interest rates.
The great shift coming out of the pandemic is supposed to be goods enthusiasm over to services enthusiasm. What will we learn at 8:30 about that continued hope?
I think we will learn that Americans are still enthusiastic about going on vacations. And this is the industries that are going to
Who are you talking
benefit.
to? John, can you help me here with Yelena, please?
Bramo's
I
away.
mean, Bramo's in Crete. You just got back from some fun-filled
breaking
trip
news, Tom.
to
Bramo's back
Disneyland.
next week, then she goes away again the week after.
Oh, really?
So
John,
Lisa's
pick
making
it up.
happen this
Since
summer.
you're tanned and rested, pick it up with Yelena.
Yelena, something we talked about yesterday down in Washington, Tom and I, was to try and get away from the aggregate numbers, the headline numbers, and try to discuss the disparity. When we have market participants turn around to us and say the consumer is strong in America, Yelena, what do you see away from the headlines?
I see that services spending is still growing, and it's growing in real terms, in nominal terms, and this is the key focus for me to watch. So yes, durable goods, other goods spending is going down. We saw a decline in real spending in May. But what is key to me is whether we see a rotation from goods spending and into services. And anecdotally, I do see that. So if that continues, we will continue to see services hiring, and that is going to continue to drive the economy going forward. I think that, seeing that employment numbers are still below pre-pandemic levels in industries such as healthcare and leisure and hospitality, I think those still have a chance to grow further.
I'm wondering what all of this means for the Federal Reserve, if anything at all, specifically when it comes to the decision in July. I was talking to Joachim Fels over at PIMCO earlier this morning, and he's like, frankly, I don't think this job report makes much difference to the Fed that's focused on inflation. What's your take?
I think I would agree with that. Yes, it will factor into the decision in July, but what's really important is to watch what happens to the CPI numbers next week and what happens to sentiment, what happens to inflation expectations. All these things will factor in, but as long as we have positive job growth, healthy, economy and decelerating wages, I think that's not going to make too much change at the end of July.
So all you need is positive jobs growth, even if it's a sub 200,000 print.
I mean,
that's fine.
Sub 100 will be problematic, I think.
Okay. Fair enough. While we're talking about things that are problematic, obviously, given the Fed is focused on inflation, they are also focused on wages. Are we now out of the concern in which we see a wage price spiral? Is that now a concern that has been pushed to the side?
I think so, because things that I look at is, the rate at which people switch jobs. So this is, to me, a leading indicator. It leads growth in wages by a few months. So we have seen that rate going down. So that means, people can demand less of a pay rise. And, those who stay at a current job, they also cannot really ask for much more as well. So
the labor study is something we enjoy flunking on economic exams. And to me, the arch plug-in is always the enthusiasm of companies to hire. Has that ebbed at all?
Well, I think companies are worried about wages now, and they are looking at interest rate.
Can they raise prices? I don't mean to interrupt, but this is key. Do they raise prices?
they do raise prices, and that's how we get inflation. So, but at that point, I think what we see is interest rates are rising. We see good demand is slowing, and we see that, you know, a lot of people are talking about recession. So companies are getting more worried about wage increases, and they may not, go there and raise prices after that.
Okay. Thank you, Elena. Greatly appreciate that. Red and green on the screen right now. A real mixed tone here. How will this fold into the markets? I mean, I have trouble, Elena, figuring out where we are in this report. John, am I right? It's not all doom. It's not all gloom. It's sort of an in-betweeny Friday, right?
I would give you that, Tom. The problem that I have at the moment is that a lot of people are hinging the Fed's next move on whatever happens with the labour market data, and I understand why that's the case.
I don't agree. I think it's inflation next week.
Tom, wait. Let me finish.
Please.
It's because the labour market data will remain robust that they can remain committed to bringing down inflation, which we'll see elevated potentially next week. Yelena, the issue that I think we all have with that is that if you concentrate on inflation and just assume the labour market will be okay, ultimately at some point it won't be, and that will be too late. And Yelena, I think that's the worry that a lot of people in this market have looking forward, that this Fed, when we ask the question, what will be the thing that makes them pause, it will be the thing that ultimately will be the nail in the coffin of the economy in this cycle.
Well, you look, for the clues on what is happening to the labor market, you don't really only watch at what is happening to payrolls. It's a coincident indicator. You look at things like jobless claims. You look at things like people who work part-time for economic reasons. You really very much look at these things very carefully ahead of time. So I think ultimately, if things are really going to start to slow down, the Fed will just, back off. And I think that's what we're going to see.
What rate of unemployment is that, Yelena?
Well, the traditional 0.5% increase. What's really interesting in the latest summary of economic projections is that several Fed participants actually penciled in the unemployment rate about 0.5 percentage point higher than we currently are. So that is telling us implicitly that they are kind of thinking maybe a hard landing is there. So that is an interesting one. So I think when we see an increase in the unemployment rate of about 0.5%, we should be really worried.
Yelena Shulacheva of Bloomberg Economics looking ahead to payrolls coming out at 8:30 Eastern Time in about an hour and 50 minutes. If you are just tuning in on Bloomberg TV and on Bloomberg Radio, we all woke up to the sad news out of Tokyo, Japan, that the former Japanese Prime Minister Shinzo Abe has died. Japan's longest-serving Prime Minister was shot while campaigning. In Japan, the current Prime Minister, Kishida, said campaigning for the election scheduled for Sunday will continue. Tom, as you know, obviously a key figure in the effort of Shinzo Abe and Abenomics was Governor Kuroda. And Governor Kuroda, moments ago, just out with a couple of headlines, Tom, and let me share them with you.
Please.
He would like to convey his deepest condolences. He said that Abe achieved many results towards ending deflation, and he pays his sincere tribute to his dedication to the economy. Of course, we all remember the three arrows, Tom, back in 2012, fiscal, monetary, and ultimately structural reforms, and Governor Kuroda, a key part of that second arrow.
Very much so, from Treasury over to the central bank duties of the president. And I think that this is something very important. David Pilling, on the watch at the FT for years, had a book, Bending Adversity, John, a number of years ago, that the arch theme of that book was our cliche of Japan flat on its back due to deflation and disinflation. And Pilling said under Abe that just flat out wasn't true. This was a people with a buoyant industry, buoyant public services with their own raging debates. But we underestimate Japan, and of course Japan this morning, in truly generational shock. There's no other way to put it.
In mourning, without a doubt about it, Tom. And when the headlines come through, we'll share them with you, of course, worldwide. We're looking ahead for this market, very much focused on payrolls Friday with a jobs number just around the corner, looking for something close to 260, 270 perhaps. That's the median estimate in our survey so far. Equity futures right now unchanged on the S&P, on the Nasdaq 100 also. Negative about 0.2%. In the grand scheme of things, though, so far this year, that is not a big move. Yield on a 10-year, 298.90, and very much on parity watch on euro dollar, 101.40. 1.43. We're negative about 0.2%. Just a little bit of euro weakness, dollar strength out there through G10. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Japan, former Prime Minister Shinzo Abe has been shot and killed while speaking at a campaign rally. The attack shocked a country where both political violence and guns are rare. A suspect was arrested moments after the shooting, according to broadcaster NHK. The man told police he intended to kill Abe because he was frustrated with him. Abe was 67 and was the longest-serving Prime Minister in Japan's history. In the UK, the Conservative Party wants to speed up Prime Minister Boris Johnson's exit from number 10 Downing Street. Johnson's office had floated the idea that he would be a caretaker leader for 3 months, whilst Conservatives pick a new leader. But now the party is drawing up plans to choose Johnson's successor by the end of the summer. And Bloomberg has learned President Biden will meet with advisors today about rolling back tariffs on Chinese goods. Reducing tariffs is seen as a potential weapon against inflation. Donald Trump imposed tariffs on more than $300 billion in Chinese imports. And the former president of Theranos was found guilty of fraud in the collapse of the $9 billion blood testing startup. The verdict came 6 months after Ramesh Balwani's ex-girlfriend, Elizabeth Holmes, was convicted of defrauding investors in the company. Both Balwani and Holmes could get 20 years in prison. Tesla's made a stunning recovery over in China. The electric car maker rebounded to a record number of deliveries in June after the lifting of COVID restrictions that had led to severe cutbacks at its factory in Shanghai. Tesla delivered almost 79,000 vehicles last month, a 145% increase in May. Almost all the cars were for the Chinese market. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm definitely in support of doing another 75 basis point hike in July, probably 50 in September, and then after that we can debate whether to go back down to 25s, or if inflation just doesn't seem to be coming down, we have to do more.
Governor Waller of the Federal Reserve committed to doing more. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Katie Lyons. Bramo back with us sometime next week, I'm told. Futures down about 0.05% on the S&P. On the Nasdaq 100, we're down about 1/3%. Lisa would take a week off when there's so much to talk about in credit. Yields unchanged on a 10-year, 298.90 on a 10-year. Very much on parity watch, Tom. Euro dollar 101.45.
Yeah, John, I heard from the Greece embassy yesterday. You and I at the Hay Adams in Washington, we did mention Crete CDS. Lisa's, studying that very carefully.
Is that what she's doing? I hope she's looking at Credit Suisse and some of the banks over in Europe too, because that is not a pretty sight right now. Tom, this just from Bank of America. New summer consensus narrative for the second half recession and 23 Fed rate cuts hits commodities and turns tech lemons into lemonade. That last point is something we need to build on through this show. This rally we've seen in the last week on the Nasdaq.
Right off the bottom.
Is it the real deal? Is it the real deal?
Well, again, and this is the way it works, folks. If you have recession and slowdown, all of a sudden they become more valuable. That's all there is to it. And that's one of the normal dynamics there that Bank of America massages now. Right now, we're going to celebrate surviving July 4th weekend with the rest of America and, frankly, the global economy. The airline business is simply booming. Helene Becker has been a huge advantage to us. With Kai von Rumer, Helene Becker owns the high ground at Cowen & Company and joins us this morning. Helene, I want to look forward into earnings as well. With all this chaos and with the airlines full, are they actually bringing anything down the income statement to make what we call airline profit?
Yes. Actually, we think that most of the airlines will be profitable. A couple will report losses in the quarter. But in our earnings preview, which we published yesterday, we think there are some positive surprises ahead, even with the flight cancellations and delays that they experienced in Memorial Day weekend and over Father's Day weekend. And I will just point out that the delays last weekend were smaller than the number of delays we saw those 2 weekends. So the airlines are cutting capacity, which obviously has the effect, given that demand is still very, very strong, it has the effect of raising ticket prices. And we think that they're recovering between 70% and 100% of the rise in the cost of fuel. As we go through the year, we're getting a little more concerned with wage inflation. The contract that United Pilots may vote on later this month provided for an almost 15% increase. American offered their pilots 17% increase. So we're definitely seeing significant wage inflation, and that won't abate, not for the foreseeable future. And so with demand still strong, although we're a little worried what happens after September.
Well, that's what I want to talk about, Helene. As you know, the price tolerance in this industry right now for the consumer just seems to be unlimited. It's immense. I'm just wondering whether it's there in the back half of this year. How do you gauge that?
Yeah, I don't think it will be, frankly. We're worried about that because consumers, you guys talk about it on the show all the time, consumers have a lot of financial pressure right now. They've got higher prices when they fill up their car to get to work, and then they have cooling their home is going up. Eventually, heating their home is going to go up. And I think there are a lot of people who really wanted to travel this summer. They haven't traveled for a couple of years, and they just wanted to get out and about. And as you go through the year, I think that after people start returning to the office again, I notice when I'm in the city, it's so much more crowded than it was just 3 months ago, 2 months ago. And so I think we're gonna see pressure on traffic growth as we head into the holiday season.
So how does an airline make longer term decisions then? Because I think about the retailers, which struggled for so long to get adequate supply, and now they're left with too much inventory as demand is waning. Right. Are we going to see a situation where airlines try to get more pilots, they try to get more flight attendants, just labor in general, and as soon as they get all of that, the demand's gone and they're overstaffed?
Yeah, that of course we worry about that too. I think the pilot issue is going to be with us for at least another 2 years, so I'm not so worried about them. And I'm not really that worried about the flight attendants. To your point, though, I think focus on the capacity and the number of aircraft in the air. During the pandemic, the industry retired about 800 planes out of the U.S. system, and those are never coming back. And then there are still delivery delays from Airbus and Boeing on especially the narrow-body aircraft. I was reading an article earlier this morning that the manufacturers can't get enough engines. The engine manufacturers are having trouble keeping up with the supply. So you're not delivering as many aircraft. And as you reported last week, you saw that the airlines cut capacity for the summer months, and that will probably continue. And that's their big weapon, right? It's just keeping a lid on how much capacity can go up. And then we also published yesterday the number of employees. As of April, we're back to 2019 levels. It's just they're in the wrong places. They're right. Everybody went. Think about pre-pandemic. Everybody was going to Chicago, New York, San Francisco, Boston, business centers, and now everybody's going to leisure destinations: Miami, California, Southern California, Arizona. And so you're seeing that shift. So people are just misplaced.
Elaine, Tom is so jealous that he hasn't had a vacation yet.
I'm backloading.
That's your own decision.
The Fed is front-loading.
I'm pretty sure I remember
John.
you went to Paris earlier in the year.
Yeah, it's
so
a rumor.
I don't feel that
Strictly
bad for
a
you.
rumor.
Helene Becker there of Cowen. Tom, you can't just flick the switch. There's not a button that says capacity and supply that you sit there in the C-suite and just go, yeah, we'll have some of that, and it arrives tomorrow. It takes a long time.
You're hitting a third rail with me, folks. I think with the pandemic, we underestimate absolutely just the logistics, the processes. John, what's it take to get a rusty pilot back in the air? I think I want that pilot to be able to fly.
I would agree with you. So, Tom, I'll ask you an additional question. It's related. What would it take to get a new pilot up in the air? How long does that take?
And it's also involving a compensation. I believe British Airways coming to an agreement with staff at Heathrow just in the last number of hours.
These things are really tough, Tom, and I know this is something you enjoy talking about. To engineer, to calibrate your company, to have the right capacity at the right time at somewhere in the future, it's a really tremendously difficult thing to do, and not just for the airlines, for many other industries as well. I mean, we've talked about the retailers, Tom. I mean, look at them. These retailers are now looking at the capacity that they should have had for last year, and ultimately it's in the wrong place this year.
I think Mr. Diamond is pretty eloquent about this usually in his annual letter, John, just talking about the hard work of doing the process of business. John, it's like what we have to do with the vast staff of Bloomberg
That's
Surveillance.
how you would describe Bloomberg Surveillance.
It was surveillance, the team that we have, the set of interns we have this summer. It's just really hard work to process it all. The only thing I can do, John, is say food at Ben's Chili Bowl in Washington. That helps the troops here. But I did notice inflation, the half smoke at Nationals pricing in at $8.45 for a damn hot dog.
I'm sure everything you just said will really resonate with Jamie Dimon.
It does.
This 3-hour operation.
Yeah. I think
it's just
he and
the same as
we should
JP
do
Morgan.
an interview. You, me, and James Dimon at Ben's Chili Bowl, National Airport.
I'll reach out to the team and see if we can make that
them.
happen. Futures down 0.2 on the S&P from New York on this payrolls Friday. This is Bloomberg.
Inflation. I think it's been clear by the Fed that that is their target.
I think they've already likely gone too far.
If the Fed feels they can't slow down from that 75 per meeting pace, that's really going to clobber the economy.
My view is that the Fed blinks. The U.S. might not be in a recession and maybe on the cusp of a recession.
We're not looking at, the Volcker recession of the early 1980s.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on this Payrolls Friday live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together with Kenny Lyons. Lisa back with us on Monday. Your market down 0.2% on the S&P. Payrolls 90 minutes away. TK, before we get there, we have to begin with the shocking news out of Japan.
On international relations, and that is not what this is about. This is the domestic sadness of Japan. This is a hugely domestic story this morning of Mr. Abe simply assassinated, however you want to call it. We don't really have data yet on the shooter suddenly shot in his arm, as Maury reported from Naga. This was sudden and immediate. He died very rapidly. John.
Media reports indicating, Tom, that the 41-year-old male suspect used what appeared to be a homemade weapon. It goes without saying, Tom, that these kind of killings are incredibly rare. In Japan, for this kind of gun violence in Japan, Tom, is truly shocking. The team breaking down the data here, and we all woke up to this sad news, Tom. In Japan, in all of Japan, across the whole country in 2021, 10 gun-related incidents, Tom. 10. That's the number for the whole of last year.
That is the society of Japan. Unfortunately, John, at least back to Meiji, I'm going to say 1850, assassination of public figures and former prime ministers is all too common. Of course, through the turmoil out of World War I, and I should say out of the Sino-Japanese War, the Sino-Russian War, rather, of 1904, I'm guessing, it has been all too common. I don't think people are shocked here by this violence of a political figure. What is shocking within the polarization of Abe is how he won for so long. He was the longest serving prime minister.
The tributes have been pouring in through this morning, as you might expect. The one that jumped out for me, Kenny Lyons, of course, was the tribute that came from Governor Kuroda of the Bank of Japan in the last hour.
Two individuals who worked so closely together on economic policy in Japan, because, of course, in 2012, when Abe came in for his second term, he wanted to get out of the decades of stagnation, wanted to get out of the period of deflation. He used both fiscal and monetary policy mechanisms to do that, and that legacy is lasting, John. Policy in Japan is still quite easy. Kuroda still is stimulating, is buying bonds in a time when global central banks are doing the exact opposite.
We'll stay on top of the headlines for you through this morning, of course. Any latest news, anything, we'll bring it to you right here live on TV and radio. I want to start with the price action for those of you very focused on the payrolls at 8:30 Eastern time. This is how we trade going into it. We're down 0.2% on the S&P, on the Nasdaq 100 down 0.5%. Of course, coming into Friday, a really nice rally. 4 days of gains on the S&P. On the Nasdaq, we've just ripped, and we'll spend some time on that later as well. Yields in a basis point, 298.35 on 10s. And here we go, Kaylee, on Parity Watch on Euro Dollar, 101.44.
Yeah, my eyes are going to be on that tick chart literally all day because, of course, we got a break of 101 earlier. So my question is, how is Christine Lagarde going to address that in particular when she speaks at the Aix-en-Provence Economic Forum later today, 7:55 a.m. Eastern time, so less than an hour until we get those remarks. How does she address this weak euro and the idea that they are trying to exit negative rates in a time in which the European economy is slowing down? They are planning to hike into weakness. What does that mean for this currency? Then, of course, the big event of the day is at 8:30 a.m. Eastern time, the payrolls report, which you were just discussing. 268,000 is the estimate for the month of June. My question is, does it mean anything at all to the Federal Reserve, who is so focused on inflation? And on that point, we will get kind of real-time reaction from at least one individual on the Fed at 11 a.m. Eastern time. New York Fed President John Williams will be speaking. To what extent does he echo the same sentiment we heard from the likes of Christopher Waller and Jim Bullard yesterday? The idea that a soft landing is possible, playing down the risk of recession, even as they talk about going another 75 basis points this month, John.
At the end of this month. Thank you, Kaylee. Looking ahead to two big data points. One this morning, another one next week on July 13th. CPI next week. Tom, payroll's just around the corner.
Well, payroll's just around the corner, and, at 8:30, what do you look at? John, I'll let you tell me. I guess I look this time around, I don't go beneath the headline data. I stay with the headline data because that's where Jerome Powell's going to be.
Let's find out where Priya Misra is right now, the head of global rate strategy at TD Securities. Priya, is this labour market data going to keep the light green for this Fed to go 75 at the end of this month?
We think so. I mean, the labor market is slowing. We're actually looking for 350,000, so slightly higher than consensus. Now, the economy is slowing, but the Fed wants it to slow. So I think all the recession talk is a little bit premature right now. Inflation is still a problem, and the Fed has changed their reaction function, I would argue. They're overemphasizing inflation, headline inflation, over the labor market right now. So, I would say that the green light for 75 is done. I actually think the next meeting, we're going to get a 50 in September. We expect continued 50 basis point hikes. And I think that if the labor market's slowing, I don't think that the Fed will change their view. They actually want it to slow.
Priya, you and I are the only two on the planet that read Frank Fabozzi over the weekend. We look at 800 pages of fixed income theory and go, oh, this makes for good reading. What is the attribute that helps you determine your terminal rate guess? Is it a finance attribute or is it an economic attribute?
So I'm glad you bring up Fabozzi. I think, I think where the Fed ends up is an economic attribute, and it's not just the economic view, it's also the Fed reaction function. I think they've lost some inflation credibility, which is why they're overemphasizing inflation. But when you talk about finance, it's how the yield curve responds. So that yield curve that's been flattening, for the last couple of weeks, I think we've been more worried about recession risk. So it's steepened. I think it's going to continue to flatten because that front end of the yield curve is all about the terminal rate, as you highlight. The long end is about neutral rate. What's the economy doing? At what point does the Fed start to ease? So I'm a lot more constructive on the long end. I think that front end, until headline inflation gets closer to 2%, we're at 9%, close to 9%, even on PCE, close to 5%. I think that front end is just going to struggle to price in, much lower rates because the Fed is on a mission here to get inflation closer to 2%.
So how much more deeply inverted could this yield curve get, Priya?
I think pretty inverted. I mean, we're looking at minus 50 on two stands, perhaps even more. Here's the problem, I think, what the market's going to struggle with. Growth is going to slow down. We're all going to be watching the Fed, whether they blink. I don't think inflation's going to allow them to blink. And, the market's pricing in rate cuts right after we reach terminal. I think that's also a little bit optimistic on the markets front. Inflation's not going to collapse in a month. So I think the Fed gets to neutral, closer to 4% by year end, early next year. And then there's going to be a waiting period where things are going to slow down. We'll keep waiting for the Fed to start to ease policy. And the Fed is going to say, I think we just have to be patient. We need to see inflation come down. That's when the curve inverts even more. And we start to pencil in much weaker growth later, into next year.
Okay, so clearly there's a lot that this bond market has to consider. The concern around growth on the one hand, the idea that the Fed's going to tighten anyway on the other, and yet the volatility in the bond market, Priya, just continues to astound me. You and I caught up earlier this week, and I think the 10-year was trading sub 280. It's now back up near that 3% level, and you described it as a toddler that's having continuous tantrums. I mean, how do you make sense of the action we are seeing in rates?
I'm glad you brought it up. It's definitely giving me high blood pressure. I think the market's moving around as much, partly due to uncertainty, right? We've got uncertainty on growth, inflation, and how the Fed responds to high inflation as well as slowing growth. But there's also a market structure issue. I think dealer intermediation is constrained. there's been a lot of regulatory pressures on dealers. I think their balance sheet can't grow. So that buffer that existed during the taper tantrum or previous episodes of big shifts in policy, I think that buffer is just much lighter. And then we've got high frequency trading and other investors that tend to, slow down when volatility is high. The Sharpe ratio of treasury trading is not great right now. So I think that's why we're seeing smaller flows having outsized reaction. So I would just say the daily moves can be all over the place. I mean, it's hard, but I think you have to think about resizing trades, entry, exit, having wide stops. I think if, that's how you maneuver this treasury market, because I think daily moves, and we've noticed the 1 sigma move. I mean, Tom will like the Fobosi talk, but the 1 standard deviation, greater than 1 standard deviation moves were at the highest level, really, since we have data, since the 90s, at least, that we have regular daily data. The only other year that was similar was 2008, and we know what happened in 2008. So I think that, I think we should realize that that's not going to go away. We're going to continue to have pretty large moves until we see clear signs from the data that it's turning one way or the other, particularly on the inflation front.
Priya, awesome to catch up. A clinic from you, as always. Priya Misra there of TD Securities. It's very, very difficult to predict what the Fed's going to do later this year and into 2023, and it speaks to the volatility. Even if you believe they blink, and many of you do, I know, that they have to respond to weaker output, weaker economic data, Tom, they can't say that right now out loud. Because if they do, financial conditions will ease, equity markets will rally, credit spreads will tighten, and that will go against their goal of bringing down inflation. So this is a really difficult one on the communication side for this Fed to balance.
On a communication side, it's next to impossible for institutions. Like our conversation with the economic advisor to the president yesterday, Dr. Boucher, I'm sorry, they're pigeonholed into scripts. Those scripts don't work in the original economic and political territory we're in coming out of a pandemic. It is original territory. I know it's a cliche. And whether it's Heather Boucher or Jerome Powell or whoever the next Fed speaker is, John, they're making it up as they go around that ballet that they have to be in control. They have to say the right thing. Baloney. What's going on? And we need to hear that from the Fed.
Hey, Tom, if they said that, if they were perfectly transparent and gave you a minute-by-minute, tick-by-tick view on what was happening, can you imagine what the volatility would look like then?
That's fair. And, we should thank Bill Dudley as an example of someone who's talking straight.
Tom Keene, Kelly Lyons, Jonathan Ferro, counting you down to Payrolls Friday. 8:30 Eastern Time, 1 hour and 20 minutes away. Futures negative 0.2%. Yields 297.98 on a 10-year, and euro dollar a break of 101 earlier this morning, 101.46 on a euro against the dollar. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former Japanese Prime Minister Shinzo Abe has died after being shot at a campaign event. It's stunning news in a country where political violence and guns are rare. A suspect has been arrested. Abe was 67. He was Japan's longest-serving prime minister and was best known for his shock therapy called Abenomics to revive the economy. Boris Johnson is still in number 10 Downing Street after announcing he plans to resign, but his plans for an orderly retreat are being threatened. The ruling Conservative Party wants to speed up the contest to choose Johnson's successor by the end of the summer. The Prime Minister's office had floated a 3-month timetable yesterday. 2 of the Federal Reserve's most hawkish policymakers support raising interest rates another 75 basis points this month. Governor Christopher Waller and St. Louis Fed President James Bullard say the move is needed to curb inflation. Both are downplaying fears the U.S. economy is headed for recession. And there's another report casting doubt on whether Elon Musk's acquisition of Twitter will go through. According to the Washington Post, the deal may fall apart over Musk's doubts that Twitter is accurately reporting the number of spam bots on the service. Twitter says it continues to share information with Musk to complete the deal. And the wife of billionaire John Paulson has accused him of secretly creating a series of trusts to hide billions of dollars from her in their divorce. Jenica Paulson sued her husband Thursday in New York. She's asking for at least $1 billion in damages. According to the Bloomberg Billionaires Index, Paulson has a net worth of $4.6 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There's no question that if you look at what the Chinese economy and the non-market practices that the Chinese leadership are undertaking, that there are sectors of the economy where they are engaged in unacceptable activities. Tariffs are one tool, but we have other tools as well to make sure that we are protecting key sectors of the American economy.
Brian Deese there, the National Economic Council Director, catching up with us down in Bloomberg headquarters, Tom, which was the Hay Adams yesterday in the nation's capital in Washington, D.C. With Tom Keene, I'm Jonathan Ferro, together with Kelly Lyons. Equity futures right now down about 0.1% on the S&P 500. On the Nasdaq, down about 0.5%. Yields on 10s down 2. Let's call it down 2. We're down about 1.5 basis points to 297.98. Euro dollar 101.40, a break of 101 earlier in the session. Just to pick up on the words of Brian Deese there on China and considering removing some of these tariffs, Tom, our latest reporting from the team, the president will meet with his advisors today on possible reductions in U.S. tariffs on Chinese goods. That meeting taking place later.
Very delicate issues. And again, the size of those reductions. Is teens-weens the proper language, John? We're really looking at, it's so political, we're looking at small nudges, right?
It's on I'd say one, yes, focus on the size, but two, focus on the where. That's going to be interesting for me.
Yeah.
What do they remove tariffs from? What do they reduce them on if it's a reduction and not a total removal? And do they double down the effort elsewhere to make this more palatable at home at a time when, as we talked about yesterday, Tom, for this administration very early on has accused the Chinese Communist Party of conducting genocide. That is a very big accusation that others have shared. And Tom, to remove tariffs on that particular government, I think is going to be a big, big deal.
No, we thanked the White House yesterday for the attendance of Boucher and Deese. We welcome all of you on radio and television here on a most unusual jobs day. Yes, we'll have complete coverage for you. Jeff Rosenberg of BlackRock, one of our guests scheduled to be with us, but also an assassination in Japan. Tobias Harris, will join us here in a bit. Truly expert on the arc and reach of Mr. Abe and particularly his domestic politics as well. Right now on the international politics and the legacy of Prime Minister Abe, Emily Wilkins joins us with Bloomberg Government. Emily, the most stunning image from the G7 meetings, I frankly can't remember which meeting, was a trilateral meeting of Biden with the leadership of South Korea and Japan. I would suggest that started with Shinzo Abe. He's the one who said to Japan, we have to reach out.
Absolutely. And I mean, this is news that you've already heard Secretary of State Anthony Blinken respond to this, saying that he has deep sadness, deep regrets about this, really praising Abe and what he was able to do. And you have this goodwill on both sides of the aisle here in the U.S. You heard former President Donald Trump also praising Abe for his relationship, his goals. Certainly, this is a shock. When President Biden addresses the nation later this morning, he's going to be talking about abortion access, but I would expect him to mention something about Abe and his legacy.
It is not a special relationship. It is so touched by World War II and the aftermath of that. But across the dynasty of the Abe family, he was trying to drag Japan into a little more assertive military as well. Explain to us what the White House desires in the Pacific militarily from Japan.
The White House has been very focused on working with its allies in that region because they see it as a bit of a counterweight to Beijing, to China, to their influence in the area. So certainly when President Biden was making some of his first trips overseas, he visited South Korea, he visited Japan. He sees them as key allies in that area of the world and sees that relationship as incredibly critical as the U.S. and China deal with various tensions among the two countries and try and figure out a path forward on some of these things like trade, like these tariffs that Biden will be discussing in the White House today.
Well, Emily, to that point, you talk about the U.S. desire to counter China, all of the tensions that exist between those two countries. As John mentioned, the White House has accused China of genocide, and yet they are looking at easing tariffs. Is this just for optics? And if so, how does that play optically if, in theory, that means you're going easier on China in some sense?
It's a really good question, Kaylee. I mean, the thing that's driving the Biden administration to be looking at these tariffs right now are the high inflation prices, the fear of a potential recession looming, and trying to see if they can provide some relief. And you guys hit the nail on the head earlier, kind of noting that this is a really incremental thing. Barclays said that any sort of reduction in tariffs would only be a drop in the bucket. And you're hearing concerns from Democratic candidates on the campaign trail. I'm thinking about Tim Ryan. He's the Democrat running for Senate in Ohio, and he has urged the Biden administration, saying, please do not reduce these tariffs that could potentially harm American manufacturers and American workers. It's fascinating to see the split screen right now in D.C. You've got these discussions going on at the White House today, while all the way down on the other end of Pennsylvania Avenue, you have Democrats and Republicans in Congress working together on legislation meant to bolster U.S. manufacturing and competitiveness against China. And so it's a very interesting dance right now that the White House is engaging in, trying to figure out whether to roll back these tariffs. No decisions have been made yet, but this is certainly something that a lot of officials in Washington are keeping a very close eye on.
Well, especially because the clock is ticking, Emily. I mean, you're in Michigan today to cover the primaries ahead of the midterms in November, which is coming up quickly. I mean, realistically, how much time does this administration have left to try to do something to rein in inflation and change the mind of voters?
It is not much time at all, Kaylee. You're absolutely right. I mean, keep in mind too that a number of these voters, they don't show up on election day to the polls. Now there's a lot of early voting in many states, and so the window that Democrats have to really change the narrative here is slipping away. And I've talked with folks, Democrats, who have said that they are concerned about the high level of gas prices. They are concerned about the fact that the price seems to go up every time they go to the grocery store. Certainly, there are other issues in the mix in this election, but those two have really remained at the top of the list. And there's just no sign at this point that they are going to ease before November.
Emily Wilkins, thank you. Emily, on the latest down in Washington and across the country. And Tom, the story unlikely to change next week, according to forecasts. We get the CPI print in the middle of next week, Tom, on Wednesday, July 13th. The estimates so far, we just got a handful of them. The median's 8.8, but Barclays, 8.8, Morgan Stanley, 8.8. They're the numbers so far from some big names, Tom, on Wall Street. They're looking for something close to 9%.
Yeah, I think we're done by this. Fancy people in suits and skinny ties, bow ties and skinny ties, John, are worried about core inflation. And the answer here is...
I'm pleased you involved yourself in that too,
Thank you. We're not living core inflation. We're living top-line inflation. Is it double digit? It's close enough for me to call it double digit. I mean, you know, let's be clear, John. You take 40 pieces like David Rosenberg does. How many of those pieces are above 8.8%?
I'll remind everyone of that headline, that number, that data point, statistic that I brought to our audience about an hour ago from Bank of America. For the lower income cohort in America right now, gas prices rose to 9.8% of total monthly spend. They're living headline inflation, Tom, in a big way.
Absolutely.
Futures down a tenth on the S&P. Payrolls an hour away. One hour away from payrolls, your market looks like this. Your equity market down about a tenth of 1% on the S&P. On the Nasdaq 100, down 0.4%. 4-day winning streak on the S&P, equaling the longest winning streak of the year so far on the S&P 500. Just 4 days. That's how bad it's been this year so far. In the equity market on the Nasdaq, we're up almost 5% on the week this week. And Bank of America's Michael Harner out with a note this morning, essentially saying the new summer consensus, the latest narrative for a second half recession and rate cuts in 2023. Tom, for him, turning tech lemons into lemonade. My question, just how credible is this move? How durable will it be?
You know, we're following this tick by tick. Are we exhausted by how the narrative changes? What? On a 2-day basis?
I'm exhausted, Tom. It's changing from data point to data point, and Chairman Powell is responsible for some of this, TK. Let's be clear about that.
Yeah,
the fact
I agree
that
with
you,
that.
Mitch, now is the difference between a 50 basis point hike and 75 in the mind of the market, I think is problematic.
Yeah, I take your point, John, but, you know, everybody's going to, as I say, it's in the stupid ad we've got out now. We're going to recalibrate. We're going to recalibrate at 8:31. John, what are we going to recalibrate over the weekend? I don't know.
Citi says that if we get something close to 290, their view, they're looking for 75. They think that the recession talks takes a back seat, and what takes a front seat, this idea we need to keep hiking interest rates. Priya Misra on board. 2s, 10s and 30s look like this. 2s, 10s have been inverted through much of this week. Priya's looking for 50 basis points of inversion, Tom.
Wow.
That is a wow. And there's a belief that this Fed needs to keep on hiking so long as inflation remains elevated going into next week, July 13th. We're looking for 8.8%. That's the median in our survey for headline CPI in America. I want to finish on euro dollar, Tom, just briefly. We're getting closer and closer to that line in the sand, 1-1 parity, euro dollar. We had a break of 101 earlier this morning, Tom, very briefly. Right now, 101.43.
I think Twitter broke down as well. This is my, in the blur of news today, I think Twitter is like euro parity.
Twitter, you mean the stock?
The stock. The stock is going through parity.
I had no idea where you were going.
Well, I didn't know where I was going either.
The Washington Post story that suggested that acquisition was breaking down. Am I here to fill in the gaps? Is that what you're suggesting?
No, John, I couldn't get a gate at Teterboro yesterday. Cut me some slack.
OK, let's take a beat. I think someone who actually knows what's going on with Twitter is joining us right now, thankfully. That's your cross-asset price action. That someone, of course, is Kriti Gupta. Morning, Kriti.
Well, good morning, John. Well, let's stick with the Twitter story because you really nailed it there. It's the Washington Post story that is moving the stock this morning, saying that the deal is in serious jeopardy. Remember, Elon Musk is due to make some remarks at the Sun Valley conference on Saturday. Some people saying that those investors, the big heavyweights in the audience, are going to push him on what that deal actually looks like and the timeline for it. Nevertheless, the stock moving this morning to the tune of down about 4%. But take a look at this. Tesla not moving in sync. In fact, it's actually moving. It was positive in reverse. We know that there's that inverse relationship between the two. Does Elon Musk's split attention mean something for the fundamentals of the company? Right now, those shares are about flat. But take a look at this. In terms of deal news, here's a stock that's really catching a bit. Occidental up almost 2% this morning. Once again, Warren Buffett buying those shares. Every time it drops below $60 a share, it seems like Warren Buffett is hopping into that market. And once again, according to a filing just filed last night, looks like he has hopped into that. That news pushing the stock up this morning. But let's get to some more kind of company, very specific news when it comes to the fundamentals. I'm going to start with GameStop here because in the last 24 hours, Tom, you've had a complete turnaround in the GameStop story. About 24 hours ago, GameStop was higher and higher by a lot because of a 4-for-1 stock split. In the last 24 hours, they fired their CFO and on top of that announced these widespread layoffs. So those shares are down to the tune about 5.5%. We're going to keep an eye on that. Levi Strauss as well. Tom, denim never goes out of style. At least that seems to be the take
Skinny jeans
analysts. Skinny jeans do. I'm wondering if Tom has one of those kind of big flared out, groovy 70s.
Bell bottoms?
Bell bottoms, that's the word. That's what I'm asking.
That's it. Kriti, you nailed that.
Hey, Kriti, you can stay for a while if you want. keep digging.
Levi Strauss is up about 4%. The analyst saying that in this environment that's kind of rough for retailers right now, Levi Strauss is coming out on top. I'm going to end here with Six Flags getting a cut to neutral and price target to cut over at Citi, weighing on the shares to the tune of about 3%.
Afterthought took a road trip to Brooklyn and unloaded I don't know how many pair of 501s on me. And, I personally moved the needle on Levi Strauss. Kriti Gupta, I guess, thank you very much for reminding me of the retail travails of the summer. Right now, on the travails of the American labor economy, Matthew Lozzetti joins us. He's been brilliant at Deutsche Bank, particularly way out front of all on gauging a recessive American economy. Matt Lozzetti, at 8:31 this morning, am I going to know if the American labor economy has finally broken in a difficult direction?
Sure. First, thanks so much for having me. We're expecting 225,000 jobs today, a little bit below consensus. We're expecting the unemployment rate to fall to 3.5%. And I think what you have is a market that is very laser focused on getting recessionary signals. And over the past week or so, we've gotten evidence that perhaps the economy is not slowing as fast as anticipated. And I think if we get our numbers, you'll get, I think, further evidence of that. I think taking a step back, you just have an economy that is showing a very clear slowing. And you have a labor market that is showing some mixed signals. We have the ISM surveys looking very negative from an employment perspective. The PMI is actually looking quite positive. Jobless claims near record lows, but moving a bit higher. And so I think we're all simply looking for, I think, better signals about the near-term trajectory for the economy. We think today will be, a solid report.
How do you link it to next week's inflation report? Taking the two together, how do you stagger from this labor report to next week's CPI report?
Yeah, so if we're thinking about the Fed trajectory and what the Fed, I think, needs in order to be able to back down from the hawkishness, I think it's two things. They need very clear evidence that the labor market is turning, and I don't think that you get that today from our base case. And then they will need very clear evidence that inflation is slowing, and I don't think that you get that on next Wednesday. We expect 0.6% month-on-month for core CPI, more than 1% month-on-month for headline CPI. So I think those two data points together, particularly when the Fed releases their new CIE, or their Common Inflation Expectations Index later this month, those things together likely keep them on track to raise rates by 75 basis points at the end of the month.
Matt, when we get this data, it pours out slowly, then all arrives at once. And I've been waiting for something that hasn't developed. We get this really strong headline print on payrolls, then unemployment doesn't drop and wages don't accelerate. Matt, what do you make of that over the last couple of months? Has that really been the story? Have you been surprised by that?
I have been. We've been surprised, and particularly in the unemployment rate number, not falling at all and essentially stabilizing here. You know, we've seen a little bit more weakness on the household survey front, which is where we get the unemployment rate data from. And in addition, you've seen labor force participation picking up, in particular for the prime age group, and that tends to put a little bit of uplift on the unemployment rate and prevents it from declining. So I think that's been an important development, but you know, you still have a labor market that looks tight on almost all metrics. We got the JOLTS data earlier this week. Job openings still really high, 5.3 million more than unemployed. The vacancy yield, you know, how are we turning job openings into hires is near record low levels. The quits rate remains elevated. And so it's a labor market that still looks very tight, despite what you mentioned from an unemployment rate perspective.
And what is your assessment of how participation may pick up in light of the inflationary pressures the American consumer is facing, especially as they draw savings down? In theory, that will drive more people back into the labor market if they've been on the sidelines. And shouldn't that have an impact on the unemployment rate ultimately?
Yeah, it should. When you look at the margins left for where we can get participation back, the prime age group, and in particular 25 to 44, really has recovered most, if not all, of the pre-COVID levels that we've seen. Really, it's in the 45-plus group, and that area remains depressed. And perhaps, given what's happened with wealth effects, we can see people come back there, and the excess retirement story kind of go away. I think bigger picture from a structural perspective has been the foreign-born workforce. And so if you look at prime age foreign-born workers in the U.S., we are about 2 million below the pre-2019 trend. That's a big source of tightness in the labor market, lack of labor supply, and it's something that doesn't seem like it's going away anytime soon.
Matt, just before you go, let's put a bow on all of it. Go through the recent calls for you and the team. You were the first out of the gate with the rest of the team to look for a recession in America. That was the back end of 23. How much have you pulled that in by, and what does that mean for your base case for the Fed? How has that changed in tandem with that?
So from a base case perspective, we pulled that into the middle of next year. At the same time, we're calling for a technical recession in the first half of this year. So we had a negative Q1 GDP growth. We expect negative Q2 GDP growth. But we're expecting the economy to bounce back in the second half of the year, avoid a more conventional recession this year, and eventually fall into recession next year. If that is the story, then I think you have the Fed moving more hawkishly, raising rates more than the market has priced in. We still see the Fed funds rate peaking out at around 4%. But I think very clearly the risks are skewed towards the economy deteriorating more quickly than our baseline expects. The potential for a recession this year in the labor market beginning to weaken this year. If that happens, I think it really puts the Fed in a bind because you have inflation, core PCE likely above 4% with a labor market that is weakening. That could very well, I think, stop them out before we get to the 4% terminal rate that we have as our baseline.
Matt Lazzetti of Deutsche Bank Securities. Matt, just wonderful, beautiful view at Deutsche Bank HQ here in New York as well. Tom, the situation that Matt just described is poison for risk assets. Let's be clear about that. If you have this situation where you have economic growth rolling over, you have inflation still around 4%, and a Fed still working out what to do, and unemployment rising, where do we go in that world?
I would say with slower inflation, slower decline in inflation, if we get that, you get a more robust nominal GDP, and corporations will adjust to that. But I do take your point, John. Forward, the idea of the phrase all boats rising, I don't think so.
The base case, a technical recession this year. Looking for that more complete recession next year, Kayleigh, with unemployment climbing, the more conventional view. That's Matt's call, but ultimately in between, you could have a Fed that's pushing rates through 4%. Nothing about these scenarios sounds good for equities, and that's what equities have been struggling with all year.
It sounds like their worst nightmare, frankly, John, and that brings us to the question, is the Fed going to blink at some point? Because there has been an assumption in this market now for a while that maybe they will, and that has given a boost to risk sentiment to some extent. But what we've been hearing is, no, this Fed is focused on inflation. They're going to keep going.
Brilliant to catch up with Matt Lazzetti of Deutsche Bank. Pushing forward to payrolls Friday. Your print this Friday morning is 50 minutes away. Less than that. We're looking for 268 on a headline non-farm payrolls report. That headline, 268, that is from our Bloomberg survey, the median estimate from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Japan, former Prime Minister Shinzo Abe has been shot and killed while speaking at a campaign rally. The attack shocked a country where both political violence and guns are rare. A suspect was arrested moments after the shooting. According to broadcaster NHK, the man told police he intended to kill Abe because he was frustrated with him. Abe was 67 and was the longest-serving Prime Minister in Japan's history. In the UK, the Conservative Party wants to speed up Prime Minister Boris Johnson's exit from number 10 Downing Street. Johnson's office had floated the idea that he would be a caretaker leader for 3 months while Conservatives pick a new leader. But now the party's drawing up plans to choose Johnson's successor by the end of the summer. Bloomberg's learned President Biden will meet with advisors today about rolling back tariffs on Chinese goods. Reducing tariffs is seen as a potential weapon against inflation. Donald Trump imposed tariffs on more than $300 billion in Chinese imports. In Texas, Governor Greg Abbott has authorized the National Guard and state police to apprehend migrants who illegally enter from Mexico and return them to the border. Abbott, who's a Republican, says he made the decision because President Biden refuses to enforce immigration laws. A White House spokesman says Abbott's past performance on the border, quote, doesn't give us confidence. Shares of GameStop are falling after the company fired its CFO and planned to cut jobs. The moves are a bid to turn around a business hurt by shifting demands in the gaming world. GameStop's growth has slowed as gamers shifted from buying game discs to digital downloads. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
He was the longest post-war serving prime minister in Japanese history. He really did bring more attention to Japan globally. He formed good relationships with a lot of international partners, other leaders. So that element of his policy and his legacy, I think, is something that people in Japan universally are proud of.
Here in New York, waking up to the shocking news that the former Japanese Prime Minister Shinzo Abe has died. He was shot in the neck while campaigning. Much more still to come on that story. From New York, good morning to you. With Tom Keene, I'm Jonathan Ferro, alongside Katie Lyons. Lisa back with us next week. For those of you very focused on payrolls, of course, that's 42 minutes away. Equities going into that number look like this. We're negative a little more than 0.1% on the S&P. On the Nasdaq 100, down 0.4%. Yields come in just a couple of basis points, 297.61. We remain on parity watch on euro dollar. We had a brief break of 101, right now 101.53. A lot of people publishing, of course, going into payrolls. Tom, Alan Ruskin of Deutsche Bank, one of them.
Yeah.
Here's the quote from him. Strong data will underscore thoughts that a mix of 3% 10-year yield and S&P above 3,800 are insufficient to, one, promote a recession, and two, bring inflation back down to 2% on a timetable acceptable to the Federal Reserve.
Amid political moment, folks, it is important at Bloomberg Surveillance to speak truly to those steeped in experience. I think of Robert Feldman at Morgan Stanley, or David Pilling, ex of the FT, with his wonderful bending adversity. But also on that list is Tobias Harris. To say he's senior fellow for Asia at the Center for American Progress barely describes a study from Brandeis to Cambridge to his book, The Iconoclast on Mr. Abe. We're thrilled that Tobias could join us this morning. Tobias, this is someone who took what Kazumi did, which was drag rural Japan into a modern urban history. That's what Kazumi did, a modern immediacy of the urban landscape. And then Abe said, we have to go further. We have to go beyond the legacy of World War II. Was he successful?
I think in a very broad sense, I think
there's certainly no going back to what Japan was like before Abe returned to the premiership in 2012. And so in that sense, I think, very much a success. And, that Abe was very fond of Mrs. Thatcher's line, "There is no alternative," when he talked about his own policies. And I think that is what Japan has now. You have an economic policy, in foreign policy. He laid a blueprint for his successors, and no one really has thought of anything better.
You wrote in Foreign Affairs magazine of the arch moment of Japan, which is malaise. Their voter turnout is appallingly low compared to recent history. How did he, and how does anybody new in Japan, bring a new spirit to political Japan? It seems to be gone.
I think there's going to be a lot of questions about Japanese democracy after today's events, and it's shocking. I think everyone is trying to think through what it means, and in some ways, Abe's assassination is a reflection of one of the best things about Japanese democracy, which is how accessible its elected officials are to the public. Japanese election campaigns, yes, they use the internet more than they used to. There's TV ads, but they're still based largely on politicians getting out there on their feet and interacting with voters directly. And I think there's some concern. Does this mean the end of that? Is there going to be security cordons? Are you not going to have that accessibility? I certainly hope not. I think it was a strength of Japanese democracy that voters had as much access to their representatives to this day.
He was an arch conservative, and also there was great liberality on social policy. I'm going to suggest he tried to drag his LDP to the center. Is there a political center in Japan in 2023?
I don't know if it's so much the center as it was. Fundamentally, he was someone who wanted his country to be strong, and basically he would do whatever it would take to do that. And if that meant globalizing Japan, if it meant opening Japan to the world, if it meant welcoming investment and tourism, and opening Japan to trade through something like TPP, he was going to do that, even if instinctively, you look at traditional conservatives, and you talked about former Prime Minister Koizumi's war with rural Japan, even if it meant taking on those core LDP interests to bring, to open Japan to the world, Abe was willing to do that. I don't think he was a reformer quite the way that Koizumi was, but he did recognize that Japan had to open to foreign influences more than it had been in the past.
Tobias, please explain to us how the response will be from the emperor and his family. It is such a unique, original relationship. How will Emperor Naruhito respond to this assassination?
What a fascinating question, because of course, there were plenty of moments with the current emperor's father, some moments of tension between Mr. Abe and the former emperor. But what it comes down to it, in moments like this that are just genuinely shocking, tragic moment for the entire nation, the imperial household has generally stepped up and served as basically given voice to those feelings of the entire nation. And I would expect as much from Emperor Naruhito. I don't think this is going to be a moment of political tension. I think this will be a moment, where the emperor speaks on behalf of public sorrow.
Just quickly, Tobias, we only have about a minute left, but you were talking about how Abe looked globally. And I've heard from many people this morning that he was a unique figure in Japanese politics in that he did have that global recognition. People knew who Shinzo Abe was. Where does Japan stand in terms of global politics in his absence?
Well, certainly, he was probably the most powerful figure in Japanese politics right up until the moment he died. Even more powerful in some ways than Prime Minister Kishida. And he was pushing, for more defense spending, pushing for a more assertive defense posture. And it's hard to see who's going to fill his shoes in terms of making that case. And so I think it introduces maybe just a little uncertainty what we're going to get out of the policymaking process. I think there's going to be a lot of pressure on Kishida to maybe continue his agenda and to fulfill Abe's mission. But there's still work to do, and Kishida is going to really have to step up in the moment and continue to live up to the blueprint that Abe outlined when he was prime minister.
Tobias, thank you for being with us this morning. Tobias Harris there at the Center for American Progress. Tom, just horrific. Deeply, deeply shocking for so many people waking up to this news in Japan.
And I think, John, moving away from the assassination to our relationship from a distance, there is a continued, in the Bloomberg world, and John, outside it, in the Western world an underestimation of the size, the depth, the economic and political reach of Japan within the Pacific Rim and Asia. This is something fairly recent, John, but there's a belief Japan, with Abe, without Abe, is flat on her back, and the pros tell me that's simply not true.
Tom, I mentioned the conversation that Kelly and the team had with Joachim Fowles at PIMCO early this morning when he said his legacy was very much still alive. The modern-day architect in Japan of the combined monetary policy fiscal effort, the renewed push that, Tom, we've seen play out beyond Japan over the last 5 years.
It'll be interesting to see, and as I mentioned again, the nascent Indo-Pacific reach of the United States of America, that has to be reaffirmed here. You wonder if we're going to hear from President Biden. Does he travel to Japan here again?
In the next hour, pushing forward to Payrolls Friday, 8:30 Eastern Time. We're looking for a number in and around 260, 270,000. Your equity market down just 0.1%. Going into that economic data from New York City this morning. Good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance.
The labor market is still very strong, and it does paint a very confusing picture.
You rely on your labor market numbers to tell you what's going on, and they've been really completely out of whack.
This is really still, I think, the post-COVID recovery we're seeing in the labor market.
I don't think Powell has any intention to create a big jump in job losses.
They can't make the labor market perfect, I think, at this point.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on a Jobs Day on radio and television. We welcome you across the nation, around the world, to a key labor economy report. And John, really all it comes down to here is Jerome Powell says it's a strong economy, but he needs a weak job market. I don't get it.
Will this labor market back up that view that we've got a strong economy? 265 is the estimate for this morning, Tom, and that will allow them to focus on inflation next week. And TK, we've talked about it a few times over the last 24 hours. 8.8%, the median estimate in the Bloomberg survey for CPI headline next week.
We're going to do that. We're going to dovetail into the labor data that we'll see here in 29 minutes and also drive forward to next week. And for that matter, forward to the July 27 Fed meeting. John, what does a jobs report mean to the Fed meeting?
Green light to focus on inflation, apparently, according to many.
75 or 50 beeps.
75 or 50. 75 is the view from Citi and Andrew Hollenhorst. Tom, ultimately, that got backed up by Governor Waller just yesterday, and arguably Bullard as well. The St. Louis Fed president arguing that we could still have that soft landing. I'm not sure how many people see it that way anymore. We had Matt Lazzetti about 25 minutes ago on this program of Deutsche Bank looking for 4% on Fed funds, but ultimately a recession in the not too distant future.
We are confident that Kaylee Lines is with us as Abramowicz stretches out to 6 weeks of vacation. We hope Crete is well this morning. Lisa, good morning to you in Crete. Kaylee Lines, the confidence isn't there. The Michigan confidence numbers and all the others are, I'm going to be honest, grim is the right word to put it. How can we have a strong economy and yet grim confidence numbers?
Because the dismal confidence numbers haven't yet translated into a serious reduction in activity. Yes, you are starting to see on the margin some sign of spending slowing down, or at least consumers shifting their spending away from some of those discretionary areas as they spend more on food and gas. But that's the fact of the matter. Yes, the sentiment indicators are waning. The activity is not yet. But of course, the Fed isn't so much focused on just the sentiment read. They're looking at those inflation expectations, and that's why UMich has come to matter so much for this market.
Within the chemistry set of Bloomberg Surveillance, John, the litmus paper is the foreign exchange market. It's helped us this week gauge emotion, gauge trend. What we've got to say still dollar on, John, as we go into this jobs report.
Hey, we are very much on parity watch on euro dollar. Patrick Armstrong yesterday, Tom, with us from Plurimi Wealth, basically said this ECB might be able to get back to zero. They'll get stuck. We're heading for recession in Europe. Right now, euro dollar, I think euro dollar gets the bad joke, doesn't it? This is going to be really hard for the Eurozone economy.
Before the data check, John, and I'll go to the first data item, we do have curve inversion and -2, make it -3 basis points. But Priya Misra in the last hour, stunning, where she thinks 2s and 10s are going to go.
She's looking for 50 basis points, negative 50 basis points.
The 2-year way higher than the 10-year.
Much, much higher off the back of a Fed that's going to be determined to bring inflation down and get rates up. Equities right now down about 0.1% on the S&P. On the Nasdaq 100, -2 by 0.4%. Crude back north of 100, just 102.67. Tom talked about the bond market at 297.98. Let's talk about the equity market a little bit more.
Yes.
The close yesterday, Tom, of about 3,900. Our next guest thinks that's where we end the year, 3,900, and that ultimately consensus estimates for earnings are too high. We've heard that a lot.
We've heard it a lot. I'm going to go to two key points here. One was a stunning news from Washington yesterday of the covering of the Dow Jones Industrial Average in the 9 o'clock hour. We thank our staff for that. And John, also on the S&P 500, the VIX, to give you that bull market indicator, or bull market rally, I'll say, is a 32-ish or 34-ish, down to 26.20. That's remarkable.
I've still not forgiven you for that yesterday,
Never
Tom.
will.
About 5 Dow references going into the opening bell on the open. Tom, I'm with you. The volatility is a big deal, and it's not just the equity market, it's the bond market too, and there are very good reasons for it.
Commodities as well, with copper imploding, and it was good to get the quote from Anaconda Copper there yesterday as well. Right now, on to this jobs report, joining us, senior equity strategist, UBS Global Wealth Management, Nadia Lovell. Nadia, what does the stock market do in reaction to a survey jobs report of nicely above 200,000 non-farm payrolls?
I think what you're going to see is a pause in this rally. You know, we don't think that this rally has much strong legs to stand on, and it isn't sustainable. I think that the Fed is going to be keenly watching the inflation number for next week. We're also going to be closely watching inflation expectations. We know that that's why the Fed had pivoted to 75 basis points in the last month. And so we're still in that camp of 75 basis points in the July meeting. And so we think that while today's job number is important, what's more important is next week's CPI number, which we think will have a 9 handle.
And you're buyers of energy on the pullback. Nadia, walk me through why.
We are. You know, we would be buyers of energy on this pullback. We continue to believe that Brent will be sustainable at $125 into the first half of next year, just given the supply imbalances that we're seeing in the market, and that should be positive for the equities. Even if we enter a recession, which, as you know, isn't our base case, the oil trades in that $80 to $90 range. Right now, the equities are pricing in something in the mid-$60 range. This is a sector, unlike the rest of the market, that still has a tremendous amount of earnings growth momentum. We're already seeing some indication from the companies disclosing record profits, cash flows for the upcoming earnings season. Free cash flow is over 14%, and returns to shareholders are strong. I mean, when you look at some of these companies that have a variable dividend component, you're seeing dividend yields in the mid to high single digits.
So, Nadia, let's put those two stories together. You're constructive on energy. Many people are constructive on energy earnings. To what extent do you think that's distorting consensus expectations for overall earnings on the S&P? And is that masking actually revisions elsewhere?
It definitely is. I mean, earnings contribution from energy sector is pretty strong. I mean, if you were to strip out earnings, the expectation for this upcoming quarter would actually be negative. You are seeing some weakness in some of the consumer-sensitive sectors like consumer discretionary. This is why this recent rally that is being led by consumer discretionary and communication services is confusing to us, and we don't think it's sustainable because the estimates needs to continue to come lower.
Okay, so you're a buyer on the dip in energy, maybe a seller on the dip in some of those discretionary or growthier areas of the market. What assumption are you making about the trajectory of yields when you put that together, and whether or not we've seen the peak in them, at least for this year?
We think that you have seen the peak in the 10-year. We're looking for the 10-year to end the year at 3.25%. I mean, in the interim, could we get back to 3.5% on the 10-year? Yes, just given the volatility that we're seeing in the bond market. But we ultimately think that inflation will start to abate. We think that CPI headline will come to under 6%. And we're also thinking the economy will avoid recession, but will slow down. And we're looking for the 10-year to settle at 3.25.
Okay, so is the worst over for growth then, Nadia?
We think so. I think most of the pullback that we're seeing or growth is behind. Could there be some additional volatility ahead for growth as yields move back above 3%? Yes, valuation for growth is still elevated relative to value. So we still continue to favor value, but we do think a lot of the pullback that you're seeing in growth is now behind us. And there are some opportunities that, particularly the higher quality growth companies, that you can start to leg into.
Nadia, where's the new 13 on VIX? I mean, if we've had a permanent adjustment of a new higher volatility, where's the new massive bull market 13 level? Is it 18?
I think it's under 20. Like, I think
under
once
20.
You see ball,
okay. Yeah.
I think it's under 20. You haven't seen. I mean, everyone is sort of waiting for vol to get to 40 to say that that's full capitulation.
Exactly.
That that might not happen, for that. But we think that you can start to see the bull market emerge, which we think will take some time. I mean, let's be honest. We're only 6 months into this bear market. The average bear market is like a year and a half. And we are seeing an economic slowdown. The Fed hasn't pivoted yet. So we're not calling for an end to this bear market. But we think that you can start to have a more sustainable bull.
Nadia, should I get out of triple leveraged all cash today, or should I wait till Monday?
I think maybe you should wait until after the CPI.
Okay, we'll do that.
Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management. That'll be the first wealth manager that tells you to stay in cash, Tom.
Well, that's true, actually. But that's an important point, John. A lot of people aren't all in cash on Global Wall Street. I think a lot of our listeners and viewers are. There's a real fear out there.
I joke, and there's a reason for it. I mean, we're looking for the Fed to go 75 basis points in July. Nadia and the team looking for 50 basis points in September. It wasn't so long ago that we were looking for what, Tom? The Fed to pause in September? That shifted pretty quickly.
Gradualism seems to be gone. Good morning to William Dudley, Dr. L. Arian over in Cambridge. He in sadness over Shinzo Abe. And I'd also point out there are any number of other people that felt transitory was baloney.
I heard from Mohammed about 2 minutes ago. He will be joining us on Bloomberg TV in about an hour's time. Mohammed Al Arian coming up.
Okay, and your other property.
Rick
Once
Reader
again,
of
he's just
BlackRock.
too busy to talk to me.
You've got to be more polite to people, Tom.
Yeah, I know. Yeah, well, he's upset with me with the Jets talk. What can I say?
I imagine that's it, and maybe the Mets talk too. How are the Mets doing this year?
The Mets are very large, actually.
Are they?
I mean, the only thing shining brighter are the dreaded New York Yankees.
What's happening with your Red Sox?
They've recovered from the malaise of April and May.
I've hardly heard any baseball talk from you this year.
It's been painful. We do some on radio. Michael Barr is very good at pointing out some baseball themes. But, John, it's far more important to... I don't know. I really just feel Gareth should have gone to Cardiff and not L.A.
You're very upset about that, aren't you?
I am.
Why don't you do a special and go to see Gareth in L.A.?
Well, we tried to get him.
Keene one-on-one interview.
On
football.
I think it'd be great. Oh yeah, that would be very informative.
Pay-per-view on Bloomberg TV and radio on a Friday night. I'd pay for that.
You and I still have an invite to the Tots. We got to do that.
We've got to make that happen next season. I agree with you. Futures down a 10th. Payrolls 20 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Naruhito Gupta. Former Japanese Prime Minister Shinzo Abe has been shot and killed whilst making a campaign speech. Abe was the country's longest-serving prime minister and still highly influential in governing Liberal Democratic Party. A suspect was arrested moments after the attack. Broadcaster NHK said he had served in Japan's Navy. Abe was 67. He was perhaps best known for his plans to revive Japan's flagging economy through monetary easing and regulatory reform, which was called Abenomics. The monthly U.S. jobs report is expected to show that employment growth slowed in June. A Bloomberg survey has a median estimate of 268,000 jobs being added. That's down from 390,000 back in May. The data will factor into the Fed's decision on how much to boost interest rates this month. The numbers are out just minutes from now at 8:30 a.m. New York time. Boris Johnson is still in number 10 Downing Street after announcing he plans to resign, but his plans for an orderly retreat are being threatened. The ruling Conservative Party wants to speed up the contest to choose Johnson's successor by the end of summer. The Prime Minister's office had floated a 3-month timetable yesterday. And for a third time, Spirit Airlines has delayed a crucial shareholder vote so it can extend merger talks with Frontier and rival JetBlue. The vote had been set for today. It's now been pushed off to July 15th. That could signal that Spirit doesn't have shareholder support to move ahead with the vote on an agreement if reached with Frontier. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Got to take this seriously. The labor market is genuinely very tight. I'm more of the persuasion, you look at the numbers, if they don't make sense, there's something wrong with the numbers.
Adam Posen there of the Peterson Institute, the president, and of course the former Bank of England Policy Committee member. A special thanks to everyone that was with Tom and I just yesterday, TK. Great roundup of guests down in Washington, D.C. Big effort of the team to put that together.
It was really successful, and to go down there in the sticking hot 95 degrees or whatever summer.
Swampy,
John,
TK.
I think we got to make we got to make it a habit to really get down there more often. And
every quarter, Tom, I think.
Yeah, I think I like that. Every quarter, make
go every
it a
3
point.
months.
Hey, Adams, overlooking the White House and overlooking a nation's politics into the end of 2022, and particularly heating up to 2024. This jobs economy this morning will heat up. We begin our coverage here into 12, maybe 11 minutes from now with a frequent guest. We are honored to bring you the former Fed governor at Booth School, Chicago, Randall Krosner. Randy, Adam Posen just on, looks for a new inflation regime where flat out we don't get back to 2%. What kind of job economy do we have if we get back and stay at a 3% inflation run rate?
Well, obviously the job market is still quite hot, even if the numbers aren't so strong today. The unemployment rate is still under 4%. We've been generating an astonishing number of jobs. So I think the job market probably will weaken, but I think it's undoubtedly the case that it will be weakening, but it's still relatively strong. The issue is going to be, what are inflation expectations? Are they entrenched? Will wage demands continue to be high?
I look, Randy, at the linkage here into wages as well. Are we even, as Powell talks about a strong economy, are we anywhere near a wage spiral?
I don't think yet. I mean, certainly people's expectations in the short run are very high for inflation, and they should be, because inflation has been extraordinarily high. The key is, will that persist? Will it be over 3 years, over 5 years, that even as the economy starts to slow down, even as the job market starts to slow down, do people say, hey, the reason I have a job is not just because I want a job, it's because I want to provide all the best possible for my family. And no matter how hard I work, I'm just not getting enough money, so I need more money. That's the psychology that they have to worry about, and that's why they're trying to move so expeditiously now to avoid that happening.
Randy, $1 trillion question. What makes this Fed pause? Where does that come from?
I don't think they're pausing anytime soon, because I think inflation expectations are at the upper end of the ranges where they've been. Short-term expectations much higher than they have been. I think they want to make sure that they really stomp out the possibility of inflation expectations moving up. And I think Powell has made it very clear. He's gradually dialed things up, soft landing, softish landing. Now fighting inflation is our priority, even if that means a slowdown. So I think made it pretty clear that it's going to take a lot for them to pause.
Randy, when Tom and John were in D.C. yesterday, they talked with Stephanie Aronson of Brookings, and she was saying the indicator she's looking at isn't jobless claims, because if you're starting to see the economy slowing down, it's not that companies are going to start firing people. They're just going to stop hiring people. So you're going to see it in jolts and job openings first. How close are we to that point where companies look around and say, okay, we haven't been able to attract workers. We can't afford to pay them enough to get them in the door. Those jobs are just going away.
Well, not clear yet whether the jobs are going away, but we've seen some of that over the last few months. Sometimes the jobs number has actually been below expectations, but it's not because the job market is weak. It's because people, they can't, the firms can't hire people, and they're unwilling to push the wages up enough to get them to come in the door. So I think it's, we'll have to see how things play out over time. But I do think that the job market is going to be weakening.
And if we talk about a weakening job market, to what extent will the Fed tolerate that weakening? What do you think the threshold is between softness in the labor market that the Fed wants to see, that it's actually trying to achieve, and that which causes the Fed to second guess itself?
Well, I think the key thing that they're going to focus on, I think, as Powell has said, is they've really kind of pivoted to focusing on inflation. And so the key thing will be inflation and inflation expectations. They understand that the economy is going to be slowing. And I think this is exactly why they need to be moving so fast now. The unemployment rate is still below 4%. So the political pressure isn't so strong yet on them to slow things down. They're not quite getting the blame for a slowing economy because, at least as far as the job market is concerned, it hasn't slowed. So that's why they need to move now. Those consequences will come later, and hopefully they won't have to go too much higher too much later.
That economic data is 7 minutes away. We'll get Randy's response to that as soon as that number drops. Mike McKee's going to break it down for us. He's back in New York. He's in the studio. Mike, what are you looking for from that number in about 7 minutes' time?
Well, the headline number is expected to be 265, and I think it's going to be an interesting question about what Randy was talking about with Kayleigh, the idea of whether companies can find workers or not. Anecdotally, in the Beige Book and in the ISM surveys, we've heard that it is still tough to get workers, at least trained workers, for the jobs that are available. So that'll be one interesting thing to watch. And then I'll be paying attention to the participation rate. It's supposed to tick up a tenth to 62.4. Yeah. The number of people who get hired, unemployed and employed in the household survey that produces the unemployment report doesn't matter whether it's a high level or a low level. It matters the difference between them and the number of people who are in the labor force. So even if we are getting fewer people hired, it is possible that the unemployment rate goes down from here.
But, Mike, to the claimed hysteresis of Blanchard and Summers, the permanently unemployed, they can't get back into the force, or even the caution of Jeff Sachs at Columbia that there's a part of America that's not going to participate in the American labor economy. Does this jobs report factor that in, or do we just forget about these people lost?
No, I think what you have to look at as this job report comes in, and in future ones, given the situation with the Fed, is we'll look at the minority unemployment rates and see if they start going up because they're usually last hired and first fired. See if they're rising. We can look at the number of people who are working part-time for economic reasons. That is another sign that companies might be cutting back. And of course, the people who are the most marginal are the ones who are going to be put into the part-time workforce. So those are things to watch as the economy deals with higher interest rates and definitely seems to be slowing down.
Mike McKee breaking down that number in real time, the best at it, in about 5 minutes' time. Then we'll get the reaction from Randy Krosner of the Chicago Booth School, and we'll catch up with Rosenberg of BlackRock. TK, bases loaded. Do you like that? That was just for you.
I like
that. Baseball.
Very good.
Bases loaded.
Very good. I mean, it's
Judge stepping up to the plate.
What's so important here?
Yankee Stadium packed. Walk-off home run against the Red Sox. Do you like that?
Kayleigh, I can't
just setting the scene.
I got
just think of a
chill.
future career. Once you push me away from surveillance, Tom.
He's been watching Field of Dreams.
They scream, see ya. Then they scream, see ya.
Yeah,
that's it.
They're coming
right,
out of
They're
coming out of a cornfield, John. I mean, that's what they're doing with the late great Ray.
Are they going to do that again, Tom?
Yeah, they do that every year. I mean, it sells like crazy. It's a nostalgia thing across America you wouldn't believe. My nostalgia, John, is to understand that this jobs report linked to inflation next week is critical.
Futures unchanged. Your payrolls report up next from New York. This is Bloomberg. We are seconds away from a payrolls report in the United States of America. Going into that payrolls report, equity futures slightly negative on the S&P 500. Yields on a 10-year look like this, down a basis point or two at 296.68. Your jobs number, Mike McKee. There's your upside surprise.
Yeah, this is going to feed the inflation side of the debate. We have 372,000 jobs created in the month of June. Offsetting that a bit is a 74,000 downward revision to the prior 2 2 months. Private payrolls come in at 381. Manufacturing payrolls are up 29,000. Unemployment rate unchanged, 3.6%, another month in a row where we're in that 3.5, 3.6 range. Average hourly earnings, bang on, 0.3, same as the last 2 months. This is going to give the Fed some comfort because the month over month is not accelerating. Now, they'd like to see it maybe go down another tick, but I'm not going to speak for where they think a good level is, but it is coming down, and that pushes the year-over-year level down to 5.1%. Now, the number that last month for the annualized rate of earnings was 5.3, revised up from 5.2. Labor force participation, though, here's an interesting number, 62.2. That drops a tick from 62.3 the month before. Economists had thought it would go up. So it looks like fewer people looking for work. I'll have to dive into the employment numbers here, but it looks like fewer people looking for work, and maybe that is why, even though we had a big payroll number, we did not see change in the unemployment rate.
Two-year yield, we have liftoff, up 8 basis points on the session now to 3.1%. Let's round that up for you. Clearly an upside surprise driving this idea that the Fed, that green light is a little bit brighter for them to go again. 75 basis points at the end of this month. Yields up, stocks down a third of 1% on the S&P. The pain, where you'd expect the pain to be, down 0.8% on the Nasdaq 100 after a pretty tremendous week for the Nasdaq 100 so far this week. We're on parity watch for euro dollar. We had a break earlier of 101. We haven't really budged that much. 101.26 is where we are, down a third of 1%, but TK 372. The big number screaming at this Fed, it's okay to go again.
Big number. Right now, it's a movable feast, and very importantly, we're going to do this for Global Wall Street. John quotes the individual yield statistics, which are important, but the spread widens out, too, on the edge of Priya misery here. We had a huge move out to negative 5.4 on the 2-10 spread, John. The key technical point for me is 8 basis points, negative 7.815 basis points. That's a pro statistic. Don't worry about it. It's too much math, but the answer is we go in the inflation. John, do we go in the 100 basis point direction?
75 is what's on the table right now. Given where they expect inflation to be.
What are they waiting for?
Given what they expected already, we'll see. I'm not going to say they won't do 100 basis points, Tom, because I thought they'd do 50 last time. Then 2 days before the meeting, they went 75. So my prediction's worth nothing. I will talk about this move at the front end, though, up 11 basis points, clearly pushing back against this idea this Fed can slow down on rate hikes anytime soon. For many people, Tom, it will be the labour market that's got to scream at them, stop. And it's not doing that right now. Inflation's going to keep nudging them to go again and go again. I have just one question for the economists out there this morning, Tom, in this data. This is another month of really robust payrolls data, Tom, on a headline. Yet unemployment's still there at 3.6%. And I wouldn't say wages are flying here. Just my perspective on looking at the incoming data, Tom. Just an observation, not a judgment about where any of this is going. Just an observation at the moment.
There's enough moving parts where everybody can find a statistic that they like. Let's go to Mike McKee for a look before Governor Krosner. Hey, Mike McKee, you're looking at the data. What beneath it matters to you?
Well, we talked just before the numbers came out about where you might see some issues, and we were wondering what would happen to minority unemployment. It is kind of mixed. Blacker African-American unemployment fell to 5.8 from 6.2. So no sign of people getting laid off, first last hired, first fired in that category. Hispanics did not change, 4.3. A rise in Asian unemployment of 0.6, which is kind of unusual, and I would guess that might be statistical noise in there somewhere, but that's at 3%, still a very, very low number there. And then taking a look at the numbers that go into the unemployment rate, the labor force fell by 353,000, even though the participation rate was 62.2. Employment was down by 315, and unemployment was down by 38. So the household survey diverging significantly from the establishment survey in terms of number of jobs, but the unemployment rate, because of the change in participation, not moving.
Quickly, Michael, here. John from Coventry emails in and says, what does this mean for the Secretary of Labor, Mr. Walsh?
It's a victory lap for the Biden administration, and he can say, look, we're still producing jobs and the unemployment rate hasn't changed, and we're seeing maybe a little bit of a sign that inflation is falling back in wages.
Let's leave there. Mike McKee with us with a John Wright, a buoyant job report. I think that's where we go.
Rock solid, Tom. And I think if you were looking for weakness, I can't see it here.
We move to the former governor of the Federal Reserve and at Booth School, Randall Krosner, for brief comments here as well. Randy, we had gradualism and a measured moment with Greenspan. Is that history now with this odd economy?
That's history. That is long behind us. You can see that the Fed now is trying to move expeditiously. Exactly as you said, this is completely consistent with their desire to move fast, and I think they are very likely to go 75 basis points at the next meeting. Obviously, we'll get some inflation data between now and then. They're also going to get a GDP report because they'll know the numbers before we know them when they make their decision on Wednesday. We'll find out on Thursday at the end of the month. But I think they're going to go 75, and I think there's nothing in this report that would slow them down from that.
Randy, there's just a question I have. I don't want to make too much of a big deal of it. It's just something that keeps jumping out to me. We keep churning out really robust jobs growth. Payrolls, 372,000. Unemployment's really stabilized at 3.6%. I'd love your thoughts on what you make of that.
Well, this is exactly as Mike said. You've got two different surveys and different ways of gathering the data, so they're not always exactly the same. And we don't always know month to month why one is going one direction, one's going another direction. But I think both of them point to pretty robust job market right now. But I do see that weakening by the fall.
And what do you make of a lower participation rate, 62.2%, Randy?
Well, it's sort of been bouncing around 62.2, 62.3. I think, it's small enough to, and it's only month-to-month movements to, it's too difficult to make too much of that. But I think what it says is that there's a large number of people who I think are just not going to come back into the labor market. I think especially older workers that had come in really, really robustly before the pandemic struck have just said, this is just too risky. There's really no need for me to be in the job market and being exposed. I want to be spending time with my kids. I want to be spending time traveling with my loved ones. And I think we're just not going to see the labor force participation rate move up to where it was pre-pandemic.
Randy, great to have you with us. Randall Krosner there of the University of Chicago Booth School responding to that upside surprise. 372,000 on payrolls and yields on a 2-year up 9 basis points now to 3.1. We can call it 3.1% on a 2-year yield. The light stays green for this Fed to go again, perhaps 75 basis points. Looking forward to catching up with the panel in about 20 minutes' time. Rick Reeder, Mohamed Al-Arian, Sabaja Rajappa, Mike Collins, and we'll talk to the White House, Secretary Walsh Tom, coming up in about 50 minutes or so on Bloomberg TV and radio.
Most interesting as well, and I just can say the smartest strategist I've heard in recent days is the strategist Jerome Powell, works for a small firm down in Washington, where he said, it is a strong economy. Jeffrey Rosenberg now leads us forward. He is with BlackRock. He is co-lead portfolio manager of the Systematic Multi-Strategy Fund. Jeff, that's a mouthful. Let's cut to the chase. How do you devolve this odd economy and the new volatility you're living in the bond market down to a systematic strategy?
Well, Tom, it's an odd economy, as you point out, but it's a payroll report, as Jonathan nailed right at the beginning, that solidifies 75 basis points. Going into this, the market is expecting a slowdown in payrolls. You heard Randy talk about that into the fall. That's still the case, but it's not slowing fast enough, and so the Fed is going to have to do more. And when you see the lack of labor force participation, and I agree with Randy, we don't want to overinterpret, 0.1,
yes,
here, there, but you haven't really seen that. And that's a real problem on the wage inflation front. So, the lack of payroll slowing here and the lack of an increase in participation is just, again, highlighting the pressures on the Fed here, that you have an overheating economy and they need to really push on the demand side. And so you're seeing the reaction in the front end, reflective of that.
Jeff, I want to go to the wheelhouse of what you do, which is linking full faith and credit into trying to not lose money here. Priya Misra over at TD Securities talks about a very serious inversion, perhaps even a greater inversion than what we saw within 2000. Folks, this is where the 2-year yield is substantially higher than the 10-year yield. What does each basis point mean of larger inversion going forward? What does that mean in the real world of not trying to lose money in fixed income?
Yeah, well, the first part of that, of what it means, and you're seeing a bit of that movement in reaction to today's print, where bigger increases in the short end, lower increases in the long end, and a flattening of the curve, is really the market expecting the Fed to tighten into a recession. And this isn't a new expectation, but it's certainly the reaction again to today's data where, as I just said, the labor markets are very hot. The Fed has to do more. And if you look at kind of what's priced into the market in a forward basis, it has the 1 year or the Fed funds rate 2 years out from now lower than where it's expected in 1 year. So what is that saying? It's saying that the market is expecting the Fed to push us into a recession. And that's the same message that you see when you talk about an inverted yield curve, that front end interest rates are going to reflect Fed policy. The longer end interest rates are going to reflect that future expectation of recession. And you heard Powell, basically admit and really in the minutes that they're willing to take that risk because the bigger risk is letting inflation become entrenched. And I think that's right.
Right. I mean, Kaylee, it's so important here. And I'll have the chart for Monday, folks. We'll do it in the 5 a.m. hour if they let me in the building. But Kaylee, I look at curve inversion and we forget how rare this is. I really got to go back 30 years to get out to a 0.5 percentage point inversion in the curve. That's how rare what some of these strategists are talking about.
Yeah, we're talking 1980s, the last time we saw a yield curve inverted by 50 basis points. And yet that is what we heard from Priya Misra earlier. She basically echoed the sentiment that the Fed is going to be focused on inflation. They're going to continue to be aggressive, even if we do see that softening in the economy. Therefore, you continue to see the short end a lot higher than the long end. So, Jeff, do you agree with that we could ultimately end up at 0.5 percentage point inverted? Would the Fed tolerate that?
Well, it's really about the broader question of how will, as we get into the fall and you start to see the impact of a slowing economy, how will the Fed balance its two objectives between inflation fighting, which is front and center? What they're saying is the number one objective. It's kind of easy to do that when the labor markets are red hot and Secretary Walsh, as you're going to have later on the program, takes a victory lap. It's going to be a lot harder for the Fed and therefore for the market to still talk about inflation as the only objective when we're looking at an environment when inflation, the year-over-year basis is coming down, but unemployment is potentially going up, or at least these payroll figures are going down. So, Priya's call on the inversion is really a statement that they're going to maintain into a slowing economy this very aggressive stance on Fed tightening. They may or may not do that. I think it's an open question as we get into data that is a little bit more mixed in terms of the growth inflation trade-off. But clearly, if they maintain this degree of inflation fighting focus into an environment that is clearly slowing, then yes, you could see that degree of inversion in the curve.
Okay, so the operative word there being if. The question of whether or not that the Fed is going to blink. It used to be a conversation of September. That clearly has shifted, with some people still looking for 50 basis points in September. How long, Jeff, do you think it will take the data to deteriorate enough that there is a potential that the Fed thinks twice?
Yeah, I think we're looking at a slowdown in the jobs market into the fall. I think that sets up, September, October, November periods where we see that kind of trade-off really starting to show up. And these reports become a lot more important. The Fed meetings are going to get a lot more interesting when you have that tension. And they're starting to think about and talk about slowing the pace. A lot of that's going to depend on the pace of slowdown in the inflation side. And there's an expectation that you get that slowdown. And so this kind of movement in two sides here, falling inflation and rising unemployment, is going to make a very difficult period for the Fed. It's not where they are today. So I think later this month, it's going to be 75 basis points and a more clear path. But I think as we get into the fall and the impact of the tightening in financial conditions shows up in the labor markets, then we're going to see this trade-off manifest in the Fed's decisions.
On radio and television, if you're joining us, Jeffrey Rosenberg with us with BlackRock. After a buoyant jobs report, two-year reacts sharply with a higher two-year yield on 11 basis points, 3.12%, with some substantial -4 basis points curve inversion as well. Equities on the chin, ever so slightly, not down a lot. Futures down 26, Dow futures down 103. The VIX comes out 0.36 points, 26.44. Jeff, you're living a Bloomberg total return all-in index of a -12%. I'm going to chart it out from 2020. Is -6% annualized in bonds. How do you hide? Do you hide by going short duration?
Well, on the rates side, so much of that is the combination of two extraordinary things, Tom. First, we came into this bond market with very low inflation expectations. This transitory was priced into the bond market. And so when you have low coupon and you have a reset in inflation expectations, that's the impact. So bond markets do a really bad job of pricing unexpected inflation, and that's what we got. The good news, if there is some going forward, is we priced a lot more inflation here into bonds. And so you've seen increases across the curve in yields, a lot of increases in the short end. And yes, shortening duration here makes a lot of sense because duration has been a tough environment and an absolute return environment. And so the yields are getting to a better place. Now, we need to see the inflation forecast validated for that to manifest. There's still a risk there, but certainly we've priced in a better inflation expectation trajectory. If we start to realize these forecasts and inflation coming down, some of that yield increase is going to be a little bit more protective in the front end of the curve.
Kayleigh, what I'm hearing here from Mr. Rosenberg is the immense amount of uncertainty going forward, and let's already sell it here up to the inflation report of next week.
Yeah, an inflation report that could near a 9 handle on CPI, Tom, on Wednesday. So that's going to be something that this bond market is watching carefully. And talking of the uncertainty that's out there, the amount of volatility we have seen and continue to see, we've almost gotten used to the idea that we see double-digit basis point moves on yields. The two-year yield right now doing the exact same thing today, up a whopping 11 basis points on the back of this data. It is remarkable the extent to which we see the bond market moving and the uncertainty that is out there. Jeff, I'm wondering when you think we will get a clear enough read that the bond market can make a decision either way.
Yeah, look at the consensus forecasts. You can find them on Bloomberg ECST. Sorry for the product plug there for you guys. But the consensus forecasts have inflation on a year-over-year basis, coming down. So we need to see that. And as you point out, the CPI reports are as important now than these payroll reports, arguably even more important as inflation is really the central issue for the outlook for financial markets. So that's what we need to see. That's what the bond market needs to see on these monthly figures, coming down into the forecast range and seeing the broadening of inflation story start to pull back. It's been a bad set 2 months in a row where it's been the opposite. And that's why we've gotten this change from the Fed, as Jonathan pointed out, expecting 50 and getting 75. That's because you've had inflation really show up on the surprise to the upside. So we will be able to have a little more confidence that we're not getting these persistent inflation surprises when you see it in those CPI reports.
Jeff Rosenberg, thank you so much. With BlackRock, always on Jobs Day. Let me give you the date again, folks. On radio, on television, good morning to you. Some good guests coming up here to close out the hour here. And we do it with equities a little bit softer, but yield moves 12 basis points. That's a ginormous, folks, CFA talk. Ginormous move to 3.13% on the two-year yield. The unemployment rate status, 3.6%. The economist Ferro said that was odd. Yeah, maybe. Non-farm payroll is a buoyant 372,000, but a revision brings it down to 298,000. Still a very, very strong number. We recalibrate now. Kayleigh Lyons and Tom Keene with Ira Jersey, Chief U.S. Rate Strategist at Bloomberg Intelligence. Ira, I want to go to you. The challenge the Fed has on something I hate to talk about, which is this balance sheet. and what the Fed's going to do with the flows of stuff they have on the balance sheet. How does a buoyant labor economy change how Jerome Powell puts in sell orders for bills, notes, and bonds?
Yeah, so the Fed is not actually selling anything. They're just not reinvesting the maturities that came up. And you saw that in a big way just a week ago, because keep in mind that the Treasury maturities are really only 2 days a month, right? The 15th and the last day of the month. So last Thursday, you saw a pretty significant reduction in the Fed's balance sheet. And that will continue, obviously, as they even ramp up a little bit more come September. And that's, will have a modest effect, I think, on the market, but mainly you're going to see that in the auctions. So when we have the 3-year auction next week and then 10s and 30s on Tuesday and Wednesday, that's going to be where you're going to see some of the squishiness in the bond market. And you actually had a few pretty weak auctions last week. People don't want to get in front of this market. Katie mentioned the volatility. I mean, this has been, I don't want to say completely unprecedented volatility, but it's been a few decades since we've had these types of yield moves.
Yeah, it's been absolutely wild. And of course, looking at the moves off the back of the data, it is more movement at the short end, a more inverted curve. Right now, negative 5 basis points. Priya Misra says we're going to negative 50 basis points. Ira, what say you?
Yeah, so we've had a call of between about negative 40 basis points for more than a few months now. I think that the inversion of the yield curve is going to look a little more like it did back in the 1990s than it did the last 2 cycles when you got to maybe negative 10 basis points on the 2-year, 10-year curve. So I think 2s, 10s, at 50 basis points would not completely surprise me. I was just talking about this morning, like, hey, we've seen so much flattening of the yield curve that we still have to be very cognizant of when does it end, and it probably doesn't end quite yet, because as both Jeffrey and Priya have said in the last half hour on your show, look, it's going to be time for the Fed to continue to be hawkish, but at the same time, that means that we're going to have rate cuts at some point in the future. So that's just going to increase the amount of inversion that you're going to get across the Treasury curve, probably.
Okay, so what would be an appropriate expectation of the terminal rate right now after this data ahead of CPI next week, Ira?
Yeah, we've still been at 3.5% at least. I think 4% is not impossible in terms of the terminal rate. And if they go 75 basis points, you heard Governor Waller yesterday in his talk mentioned front loading of hikes, so another 75 and then 50 in September. They go another almost 200 basis points this year. You could get up toward 4%, particularly since it looks like the glide path of inflation is going to be a bit slower, I think, than had been hoped. So I think that means that the Fed might have to just hike just a little bit further than maybe the baseline expectations of some people. So that means that you can get 2-year yields up another 30 or 40 basis points in a hurry.
Ira, thank you so much. Ira Jersey with us. Back-to-back, Jeffrey Rosenberg and Ira Jersey. No one does that like Bloomberg surveillance. The VIX out a full stick now, the VIX out 0.37%. I'm sorry, that's my annual mistake. 26.45
yes.
is okay. Let us switch to the equity markets right now and take every advantage here with Michael Casper. He's with Bloomberg Intelligence, equity strategist, a CFA. He's the only one in the building that can spell Schenectady, so we're glad that he could be with us today. Tell me what is happening across Gina Martin Adams' world with earning revisions. How are you preparing, given a buoyant job economy, for the mystery of guidance in earnings?
Yeah, earnings revisions have started to come down. If you look at our chart book from last week, we have a net revision breadth chart, which shows the number of negative revisions versus positive revisions. And that's finally starting to turn over. That's finally gone negative.
Do you have a number on earnings growth? I mean, forget about guidance forward. At the present of this earnings season, what's the statistic you have on earnings growth?
It's going to look, or at least consensus is close to 10%, but again, it's kind of a mystery where margins are going. I mean, margins are slowly being revised down, operating margins revised down, and the magnitude of the miss on operating margins is really the big question, where that EPS number is going to end up.
How much of that margin pressure do you anticipate is going to come from the labor side, considering, yes, we saw 5.1% year on year, but month on month, we were steady. It doesn't seem that wage growth pressure is getting worse, at least right now.
Yeah, I think still quite a bit, and that's going to be mainly a problem for discretionary and tech and some of the more growthy stocks. But that the non-farm payrolls number coming in way higher than expected kind of suggests the Phillips curve is back in vogue. Inflation's going to remain high. Margins are going to remain under pressure.
Okay, we're just getting some headlines out of Raphael Bostic of the Atlanta Fed right now. He's talking about how the jobs report shows the economy is strong, saying that they can move 75 basis points at the next meeting and not damage the economy. How much economic damage do we need to see before it does real damage to earnings growth that, by and large, even given all of the supply side input cost pressures we have seen, have been able to hang in there?
Yeah, there's going to need to be quite a bit of damage to hit earnings growth. I mean, when you have high inflation, you're also going to have high revenues, right? So revenue growth is still going to be pretty strong. You've really got to collapse that margin line. And companies have been pretty good about taking that hit in stride. You've really got to collapse that margin line, though, to get the hit on EPS.
Are you seeing companies adapt? Just as simple. I'm a huge believer that given the cards dealt, companies adapt. Are you seeing, within the microcosm of a zillion companies in America, are you seeing the beginnings of adapting?
Yeah, I mean, the
one example.
The one that really sticks out in my head is Amazon. They put that 5% surcharge on for inflation a couple months ago, and that's just really an example of one of the biggest companies taking advantage of the inflation situation and adapting.
Does the zeitgeist underestimate what you at Bloomberg Intelligence are seeing every day?
Not necessarily. I don't think so.
Okay, well, you're allowed to, Kaylee, Michael's got to help us here. He's supposed to say, no, Bloomberg Intelligence is all-knowing.
Yeah.
They are all-knowing. We so appreciate their insight. If we could take this down to kind of the sector level, I automatically, after data like this, after looking at the moves in the bond market, take a look at the banks and just looking at the select sector SPDR ETF, which is how I kind of gauge the action for the sector as a whole before the opening bell actually rings. Up 0.25%. How do you balance the idea that, yes, the Fed is going to be hiking rates, that's going higher, but you also have an inverted yield curve and fear around a recession, and put it into a thesis for the financial sector?
Yeah, so the financial sector, trades very closely with the 2s10s curve. Obviously, that's inverting, possibly getting even deeper inverted. So that's going to be a negative for financials performance. Kind of doesn't matter as much for the fundamentals for financials. That's going to be more about the 3-month, 5-year, and some of the other curves. But certainly performance is going to be impinged by the 2s10s inverting in such a way.
Michael, thank you so much. Michael Casper with us with Bloomberg Intelligence. Kaylee, let's wrap this up if we can. I'm going to go through the job statistics with a 3.6% unemployment rate. I would note Canada with actually some negative numbers, but they get, I believe I can say, a record low unemployment rate north of the border. That in itself is interesting as well. And then on the jobs run, I'm sorry, Kayla, we're running at a 300,000 level.
Yeah, it's hot, Tom, and maybe hotter even than the Federal Reserve would like, even though they want to be able to say the labor market is strong, it can tolerate this economy, us being aggressive and hiking rates. But at some point, they're going to want it to cool down. That's kind of the goal here. And you're not seeing it yet. As we think about all of that, what we are left with is a big move at the short end of the curve. The 2-year yield right now is up about 10 basis points. It is an inverted yield curve to the tune of about 4 or 5 basis points at the moment, with the long end kind of hanging back a bit.
Wow.
It's pretty stunning, these moves in the bond market. I know I should be used to it by now, Tom, but every day it's just wow.
Well, no, as we heard someone say this morning, multi-decade gyrations here that we see. The heart of the matter is, though, folks, within what we've observed this week is the great miscall on weak dollar. It just simply hasn't happened. We've spent far too little time this week on EM economies, which really have struggled. They get a little bit of a breath of fresh air today, but it's been brutal for EM against strong dollar. And I do want to point, just looking at the major DXY index that has less of EM in it than the Bloomberg index, we are way out over 2 standard deviations in a strong dollar move. And Kaylee, as we go into the inflation report next week, dollar dynamics still critical.
Yeah, and parity watch probably also going to be where we are next week. Right now, euro dollar 101.44, Tom. Of course, we had a break of 101 earlier today. What does that mean for Christine Lagarde? We've talked so much about the Federal Reserve. What's the ECB going to do?
It was a fragmentation July. Please stay with us on the many stories this Friday on radio and television. Good morning.